or in a better, improving nominal growth environment.
You're seeing broadening of work under the surface.
The U.S. equities valuations we're pretty much at a big...
You're having a global rally, and you're having a much more balanced rally.
It's earnings that's really going to drive the market this year. We think the market's ending around 6,600.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. Bloomberg Surveillance starts right now with equity futures on the S&P 500 declining by 0.2% on the S&P, following back-to-back all-time highs. On the Nasdaq 100, we look like this. We're down by 0.2% on the small caps, down by about a quarter. The main event later this morning, about an hour from now, we'll be catching up with the Treasury Secretary, Scott Bessent.
And a key question is going to be how much he looks at the bond market as the key U.S. bond salesman, as well as the deficit at a time where that is going to ultimately be the check. This is the moment where we want to understand how these conflicting policies come together in a way that does not increase inflation, does not bloat the deficit, and allows for a 3% growth backdrop.
At the same time, also, how is he thinking about tariffs today as opposed to prior, before he was in the administration? He's talked about three ways: revenue raising, negotiating tool, and reciprocity. Yesterday, last night, very late last night, Trump saying it's possible maybe there's a deal with China. Also, when it comes to the deficit, how do you keep it in check when, besides extending TCJA and some of these other tax priorities the president has, now they're thinking about Doge dividends?
He's got a lot to think about, including tariffs. Early March, 25% on Canada and Mexico. The middle of March, 25% on steel and aluminum. Then we go into April, 25% on autos, chips and drugs.
You know, Julian Emanuel of Evercore ISI had a wonderful point overnight, which is it's not a coincidence that we're hearing all of this discussion around tariffs and the bigger every single day from Donald Trump at the same time that we're seeing record highs in the U.S. equity market. To the extent that markets are offering any kind of check on tariff talk, they are not. And that, I think, is only emboldening some of this discussion and raising the bar to really go big.
Stocks keep climbing a wall of worry. We talked about one sector that's done that repeatedly over the last few months, and that's autos over in Europe. Autos got a reality check this morning, and that reality check came from Mercedes-Benz. Mercedes expecting a sharp drop in earnings. Bear in mind also that imports to the United States, more than 60% of the autos sold here. So they're going to have some difficulty if they get tariffs too. They're now cutting costs. They're not the only ones.
And they're cutting costs into profits declining to near pandemic levels. At the same time, yesterday, you also got a bit of a reality check in the European auto sector when it came to stock performance. Suddenly, people are waking up to the possibility that maybe some of these tariffs could be implemented and could have real reactions and rebound effects on the economies outside of the United States.
Autos is so important because it's one of the biggest grievances President Trump has when it comes to the European Union. There's a 10% tariff on U.S. autos going into Europe, 2.5% if they want to come here. But Jonathan, to your point on the reality check from Mercedes, they plan to reduce global production capacity for cars. Doesn't sound like they're moving to the United States to produce more cars and more factories.
Overcapacity has been an issue that's plagued some of those names over in Europe now for quite a while. If you are just joining us, welcome to the programme. Equity futures here down by 0.2%. Later this morning, about an hour from now, live and exclusive on Bloomberg Surveillance, 25 minutes with the Treasury Secretary, Scott Bessent. Coming up this hour, we'll be catching up with John Stoltzfus of Oppenheimer as stocks hit another fresh record high. We'll speak to Terry Haines of Pangaea Policy as President Trump floats Doge payouts, and Gennadiy Goldberg of TD as Trump backs a $4.5 trillion tax cut proposal. We begin this hour with stocks steady. The S&P 500 notching another record close. Traders brushing off signals the Fed is in no rush to cut interest rates. John Stoltzfus of Oppenheimer saying drivers of the bull market include the success the Fed has had in pursuing tighter monetary policy aided by consumer resilience, earnings and job growth, which have provided support for the US economy and for markets too. John joins us now for more. John, welcome to the programme, sir. Just to pick up on those minutes that we got yesterday afternoon from the Federal Reserve, they are in no rush to cut interest rates. Does that matter to this market?
We don't think so. And, you know, it was no surprise to us. We can't help but say, John, that when you look at or you hear or you read anything that Jerome Powell is saying, it's very clear that he doesn't want to be Arthur Burns, you know, and he doesn't want to have to get dramatic as did Paul Volcker. He wants to be his own man, and he wants to ride through this stickiness of the inflation. So it's going to be a while before the crowd that wants to see lower rates from the Fed gets any kind of pleasure here. We think the Fed will probably wait until mid-year if it's going to cut, and then probably just a quarter and maybe at the end of the year. And mostly, again, as we've said before, a down payment for the market to recognize, indeed, the hike cycle is over. We're moving towards normalization. Be patient.
John, we'll have a detailed conversation on policy later on this morning with Secretary Bessent. Are you putting more weight on the earnings versus policy at a time when there is a policy obsession coming into 25?
I most certainly am really looking at earnings on this. And, we believe that we're going to see at least 10% growth in earnings this year. We think a lot of that is reflective and related to the progress the Fed has made, the resilience in the consumer, even as the economy has slowed somewhat, and as well as the resilience of business. And when you look at that, that's a very good support to this market. In addition, you do have an administration that is much more business friendly in policy, but you do have a lot of headwind here dealing with geopolitical things. Approach that tends to shock sometimes from the administration in terms of the way it negotiates.
John, when you talk about earnings growth, we're talking about specific stocks that are delivering outsized growth, and then you have the big drivers of a lot of the outperformance over the past couple of years, big tech, and they haven't been outperforming in the same kind of way. Could you get a pretty good backdrop and yet pretty unimpressive overall gains to the S&P 500 just simply because the drivers of any gains are going to be so different and so much smaller than they have been traditionally?
Well, I think that's a great question, Lisa, but I think we're already beginning to see it in that with the broadening of the rally that we've seen. We've also seen a broadening in terms of our earnings growth. When I was looking at the EA page on the Bloomberg this morning, our earnings growth is now up in the fourth quarter, year over year, over 10.4% on back of about 5.4% revenue growth. And if you look at it, the thing that's really very comforting is what you have 8 sectors that are positive earnings growth. 7 of those are double-digit earnings growth. Only 3 are negative earnings growth, as I recall. And what you have in there, that's where you have double-digit negatives. And as I recall, it's materials, industrials, and energy, which it makes sense based on where the global economy is. But it looks like things are actually moving to get a little bit better as we move forward in that area. So not at this point, we think 7,100 could be very likely our year-end target may work very well. And my gosh, what if we would have to raise it at some point?
Wait, hold on a second, John. 7,100. And this is something that you've been the biggest bull on the street for a long time. And you've been right for a number of years and haven't been bullish enough, if anything. What's going to be the main obstacle to get to that level at a time where everyone's trying to shut out noise and decipher what the signal is from a host of different policies, a budget that could come out with a potential $4 trillion addition to the deficit, and a lot of questions around tariffs?
Well, I think, part of what's going on is that you've got so many moving parts here. But fortunately, I think that the market is focusing on that, on businesses itself and on the consumer and on the Fed. And all of those things seem to be very supportive of the market maintaining a relatively calm, observing what really counts. And just if we look at the last 4 quarters reported, from last year through now, really things are showing they're getting better. They're not always in increments in what you would expect moving forward if you're overly optimistic. But if you right-size expectations, a combination of all that I've mentioned, all of the aforementioned, plus innovation and the developments that are occurring, tell us that we're still very much in a bull market. Technology is sharing the center stage in terms of the appetite of investors. You're also getting some interest now among the market capitalizations and style. You've got, I think, on our last read that we did last week, in terms of style, you've got value playing a much better role in terms of large caps. But when it comes to mid and small, it's growth is performing better. And gosh, doesn't that make sense, really, if you think about it.
John, you said the Trump administration is business friendly. Do you think tariffs can be business friendly?
You know, that's a good question. That's a real tough one. When it comes to tariffs on a traditional sense, if it's done for protectionism or jingoism, tariffs are a bad thing. If tariffs are done because other countries have tariffs that are unfair towards your country's manufacture, your country's production, your labor market, then tariffs might very well be something in a reciprocal fashion that, at least as a challenge, would open up an opportunity for a better environment. I think the problem is for decades now, many decades, we've really given away so much of our production. The fortunate thing is, as consumers, we have great buying power. And I think, for China recognizes that Europe can't replace us. And I think that the emerging market in general does, and Europe realizes that they need us as well. And, it's just like if you look at the interdependence in North America, Canada needs us, Mexico needs us, and we need them. So, we're big proponents of the idea it's not the end of globalization. It's not some kind of cranky populism that drove the U.S. into a depression in the late 20s into the 30s, but rather what it is, it's a new view to a diversification of globalization away from one country centricity, where more players will be able to enjoy playing a role in it. And we think it's very feasible. It's just we're not used to the idea of the U.S. stepping up to the plate and say, we need to bring back some businesses, we need more cooperation. We probably have been giving too long. Sounds like a country music song, doesn't it?
It's a big change. There's some lyrics there, that's for sure. Hey, John, appreciate it. Thank you, sir. John Stoltzfus there of Oppenheimer, bullish with equities at all-time highs. Away from the index level, this market is moving on spending, but on spending cuts, not on spending increases. This came from the Washington Post late yesterday, that the US military reportedly developing plans for cutting 8% from the defence budget in each of the next 5 years. Palantir, going into the close, got absolutely hammered off the back of that story.
A significant proportion of their budget is financed through government spending, which is the reason why Palantir got hit pretty hard. What's notable is something that you picked up on yesterday, which is over in Europe, the defense stocks have been flying. In the U.S., there's skepticism. You're seeing that with Lockheed Martin as well and a couple of the other defense stocks, that they are going to make cuts, especially yesterday, as they started to engage with Defense Department cuts at a time when a lot of people are saying there still is a lot of fat to trim.
I should say got hammered in the context of going vertical over the last 12 months. Down again this morning in the pre-market, negative by close to 3%. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The rift between Presidents Donald Trump and Volodymyr Zelensky seemingly deepening on Wednesday. On Truth Social, Trump called the Ukrainian leader a dictator without elections. Zelensky accused Trump of repeating Russian propaganda. The U.S. president also said Zelensky better move fast to reach a deal with Russia, or he is not going to have a country left. Elsewhere in tech, Apple has unveiled its iPhone 16e, priced at $599, a new low-end smartphone as an attempt to revive growth after a sluggish holiday season. The new phone goes on sale Feb 28th. Pre-orders begin tomorrow. Delta Airlines is offering $30,000 to every passenger aboard the regional jet that crash-landed and flipped upside down at the Toronto airport earlier this week. A Delta spokesman said the payments are a good faith gesture and have no strings attached. There were no fatalities among the 76 passengers and 4 crew members involved in the accident. And that's your brief, John.
Danny, thank you. I'd want top tier for life. I'm not sure 30K would get it done.
So you're saying that basically you go back to them and say, give me another offer.
My goodness.
Yeah, top tier.
Without a doubt. I'm not giving anyone advice. I'm not a lawyer. But for me personally, to get back on a plane after going through an incident like that, that wouldn't get it done for me.
You would need Delta One access and Delta One lounge access in every single flight.
At a bare minimum. At a bare minimum. Without a doubt. Let's see what happens with that story in the months to come. Equity futures right now on the S&P, negative by 0.2%. Up next on the programme, the Doge dividend.
There's even under consideration a new concept where we give 20% of the Doge savings to American citizens and 20% goes to paying down debt because the numbers are incredible.
That conversation up next with Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. 45 minutes from now, a conversation with the Secretary of the Treasury, Scott Bessent, a little bit later this morning, live and exclusive on Bloomberg TV here in New York City. Don't miss that, 7 a.m. Eastern Time. Equity futures right now on the S&P 500, slightly softer. We're down by about 0.2%. Under surveillance this morning, the Doge dividend.
I signed an order creating the Department of Government Efficiency and put a man named Elon Musk in charge. They're curbing inflation and saving taxpayers billions and billions of dollars every single day. And there's even under consideration a new concept where we give 20% of the Doge savings to American citizens and 20% goes to paying down debt, because the numbers are incredible.
So here's the latest this morning. President Donald Trump proposing to use savings from the Doge cost-cutting efforts to pay down federal debt and give Americans cash while speaking at a conference in Miami. Joining us from that conference in Miami is Bloomberg's Tyler Kendall. Tyler, how long did that address go on for yesterday evening?
Well, John, it went on for over an hour, and we saw President Trump sort of do his signature weave there, hitting on a bunch of issues from trade to, of course, also this Doge dividend. And those remarks front and center was Elon Musk, the man that he credited there in that bite. We should note that, of course, Doge announced earlier this week that it had cut $55 billion over the last month. But according to documents analyzed by Bloomberg News, it might actually be a fraction of that cost. But President Trump tried to use this as a way to talk about how his economic policies could bring a revitalization to the U.S. economy. Now, Mick Mulvaney, he's the former White House chief of staff, he was on Balance of Power earlier this week. He said Doge is a winning issue for Republicans because what taxpayer likes waste? But it's going to get more complicated than that. A couple things we're watching. The bulk of these federal cuts are to the federal workforce, and those employees are all around the country. Only about 18.5% are in the nation's capital, and Republicans are already sounding the alarm that they are hearing from their constituents, and it's only getting more complicated from here, John, particularly as Congress starts to weigh the way forward on President Trump's reconciliation and fiscal agenda after he threw his weight behind the House plan yesterday.
Well, Tyler, he wasn't just making news there in Miami. He also made news on his way back to Washington, D.C. Potentially now, trade negotiations might start with China.
Right, Annmarie, saying that on Air Force One to reporters who were there. And it came after he really spoke about his tariff plan also during these remarks. So we're going to be watching closely, looking forward to your conversation with Treasury Secretary Scott Bessent later today. You'll recall during his confirmation hearing, he was asked about tariffs and about the way forward when it comes to trade with China. And he floated this idea of perhaps doing some sort of catch-up provision under the Phase 1 China trade agreement to help bring China back up to those purchase agreements that they had made under that plan. Perhaps that is something that we could see here. You sort of heard President Trump talk about it, saying that he had reached this agreement previously and that they didn't live up to their purchase agreements, particularly when it came to agriculture products. So maybe that's a starting point here, but it's definitely complicating matters, particularly by the fact that that 10% tariff has already been slapped on.
Hey, Tyler, appreciate it. As always, we'll catch up with you a little bit later this morning. Tyler Kendall there on the East Coast, down in Miami. Joining us now to extend the conversation, Terry Haines of Pangaea Policy. Terry talked about the proposals on tariffs, March 4th, March 12th, April 25th, steel and aluminum, Mexico and Canada, then the reciprocal tariffs on drugs, on autos, on chips. Terry, a lot thrown at the wall. What do you think sticks and why?
Well, good morning, everybody. I think a lot of it sticks, but what you're going to end up with is, and again, a lot of it sticks depending on country, depending on geopolitical issue, and depending on reciprocity, depending on what the other countries are prepared to do, either before the tariffs come in or what they end up doing in negotiations with the United States. I think it's underappreciated that what Trump is trying to do is actually lower trade barriers across the board. But we'll see if other countries are interested in doing that. But we're entering a moment of kind of maximum market uncertainty about the broad panoply of things that are going on in Washington, and tariffs are one of those.
Also added to the list last night, Trump is thinking about potentially a 25% tariff as well on lumber. Terry, he talked about potentially reaching a fresh trade deal with China. Now, remember, China's the only tariff that Trump talked about that is actually in place, an additional 10% on Chinese imports. What conditions do you think this administration wants to see to get to a trade deal with Beijing?
I think what they're interested in, first and foremost, and fundamentally, is a lowering of geopolitical temperature, a lessening of geopolitical risk. Let's remember the basics that are, we are supposedly in competition with China, both on geopolitical levels and on economic levels. And I think what he's going to be interested in having is a lowering of the geopolitical temperature. And he's also going to put back on the table a lot of the trade-related things that were front and center in the first administration, things like intellectual property and all the rest. And I think the Trump administration gauges that they're in a better position to try to press their own economic advantages with China this time, given the relative economic positions of the two countries.
When it comes to the uncertainty in the market, a lot of that comes from tariffs. The good stuff, like the tax cuts, Congress is still mulling over. What is your base case that gets done in terms of extending TCJA and some of these extras Trump has talked about on the campaign trail?
Well, I think two things. One is on the tax cuts bill. I think that's still second half of this calendar year, and I would look to the fourth quarter specifically. There are lots and lots of hoops that Congress has to jump through before they even get to the tax bill, and the tax bill is going to end, determining the size of the deficit, determining how much money is how big the deficit is and how much they can pay for, all those sorts of things. And that'll take up most of the first half of the year. There's going to be additional uncertainty, too, in March, I think, for markets, because you've got not only the State of the Union address, which I think probably jolts people, but you're also going to have a likelier government shutdown than you had before because of Democrats focusing on using that to protest against spending cuts that are going on now.
Terry, do you think that it's feasible for this administration to send every American $5,000 from the savings from DOGE at a time where those cuts are supposed to be an offset to some of the excess spending that is going to be in this budget?
If Washington politics were Hollywood, Hollywood calls these all concept meetings. I had a concept lunch about this. I had a concept lunch about, doing that sort of movie or whatever. We're in the concept phase here, and I think a lot of these are put out to tease people and to tease voters specifically that. The president's thinking about them and trying to return some of the benefits that the government's taken away. It has great rhetorical impact, but I think we're a very, very long way away from deciding whether it's serious.
Just finally, Terry, you said that we're at maximum market uncertainty. We just had the third record S&P close yesterday of 2025. I just wonder if the lack of market turmoil in response to this uncertainty is just emboldening Donald Trump to really go further with some of these tariff threats.
Oh, I think so. That and a whole bunch of other things. The way that they look at it from inside certainly is, look, the markets think, I, the president, and the administration are generally doing good things, and that we will continue to do good things. So there is therefore a fair amount of market confidence demonstrated in what you say, and that they think that will continue. I think that gets tested a little bit over the next month, but that's actually what they think today, yes.
Terry Haines of Pangaea Policy. Terry, appreciate it. Thank you. Amazing to watch these proposals come together in real time. James Fishback and on X posted on the social media platform making the suggestion. Elon Musk replied, said he'll speak to the big man, the president. Goes on, I guess, to speak to the president because it's in the address yesterday evening.
And all of a sudden, we're talking about $5,000 checks signed by Donald Trump in the Oval Office. The key question is, how much does this signify how people want to make this popular at a time and ahead of cuts to some services that could potentially bite?
To Tyler's point, he was really doing the weave yesterday to be able to add in these DOGE dividends. Also, last night, newly minted Commerce Secretary talking about how Trump actually wants to just abolish the IRS.
I can't speak for 60 minutes straight. I can speak in like 5-minute segments. 60 minutes straight.
This was about 90.
I just can't. I can't do that.
You can't.
I just can't do that. Back-to-back all-time highs on the S&P 500 for the first time in 2025. Equity futures this morning pulling back by 0.2% on the Nasdaq 100 on a 5-day winning streak, something we haven't seen so far this year. You've got to go back to 24 to see a run that long. We'll see if we can extend that run. In the bond market, 2-year, 10-year, 30-year shaping up as follows. The 10-year at the moment just about unchanged, 452.48. At the front end of the curve, big talk about the Federal Reserve. Then we've got to ask the question now. Never mind what would it take to hike rates, what would it take to cut again at the Federal Reserve?
They right now are on pause until they see meaningful progress on inflation. Now our focus is on what is meaningful progress on inflation, what counts as that. Yesterday, I have to do a mea culpa. The meeting minutes were fascinating. They were not snoozy. They did not warrant a nap. They were something to be really scoured, because it wasn't just the commentary that was more hawkish on that side. It was their commentary around the balance sheet that was more interesting, saying that maybe they're going to pause quantitative tightening ahead of debt ceiling debates.
I'm pleased you took an interest.
It was great. It was really exciting.
I think TK's influenced you a little bit too much.
What about meeting minutes?
No interest in the minutes, no interest in the statement,
you know what?
No interest in the speeches.
A lot of the speeches have been trying to make no news, right? I mean, how do they move something forward at a time where there just is lack of clarity and they don't have any insight on that? The balance sheet aspect, though, is fascinating at a time where people are concerned about the reserves in the system as that balance sheet gets wound down.
Let's turn to foreign exchange. Sneak peek of the euro at the moment. Then I want to turn to the Japanese yen. Euro dollar at the moment looks like this, 104.40, positive by a little more than 1/10%. The outperformer on the year so far is the Japanese yen. The outperformer on the morning so far in G10 against the dollar, it's the Japanese yen. One official at the BOJ suggesting more hikes to come.
They had growth that outperformed. They have been beating expectations when it comes to pay growth, when it comes to just outright growth. And now people are talking about Bank of Japan rate hikes at a time where the U.S. is certainly on hold. Some people have talked about maybe cuts later this year, but those seem to be erased from the table. Key question is, what does that mean about the flow of capital? And that's something we've talked about with Terry Wiseman, given how much these Japanese investors have been buyers of U.S. assets into weakness of Japanese yen.
Dollar yen, 150.14. On our radar this morning, some of our top stories. President Trump suggesting that some savings from Doge and the cost-cutting measures could be sent to taxpayers. Trump pitching 20% to American citizens, 20% to paying down federal debt. Elon Musk previously floated the idea of $5,000 tax refund checks.
So Doge dividend checks, reminiscent really of the COVID checks that were sent out and Trump actually signed. And a lot of voters say they remember that. So potentially Trump is trying to tap into that idea. The question I think all of us have around this table is, so 20% goes back to the American people, 20% goes to pay off the deficit. Where does the rest of the 60% go?
That's one question. And how does this factor into balancing the deficit and the budget? The other question is, let's take it on face value. Let's say everyone gets a $5,000 check. Wasn't the direct check payments really responsible for some of the inflation that we saw in 2020 on the back of the pandemic? At what point does a $5,000 direct check to every single American act as an inflationary impulse at a time where that is exactly what Donald Trump does not want?
It's something what the team was talking about a little bit earlier this morning about non-inflationary growth, which Secretary Bessent himself has been pushing in various interviews over the past few weeks. That's something we can talk to him about in 30 minutes' time.
Absolutely. And also, you have to think, how much does this hamstrung Congress then? Because Doge is supposed to have an effect to have these pay-fors for extension of TCJA and all the extras Trump wants to do, like no tax on Social Security, maybe closing the carried interest loophole, no tax on tips. How much can you do if you're actually now just starting to send checks out the window?
Let's go to the bond market and check the scores. The 10-year yield is down every single week that the president has been in power. It's only been a month, but that's been the story so far. Yields declining, not pushing higher.
And part of the reason is because people are looking at the discussions on tariffs more than potential fiscal impulse, because that's where the conversation has been. At what point does that shift? Does it shift, or is this really going to be the path forward that makes it easier?
Let's talk about the tariffs. Trump also discussing the possibility of a trade deal with China, signaling his willingness to shut down a brewing trade fight. The president didn't mention the parameters of a potential deal. Any agreement, of course, likely to face obstacles after Trump hit China with an additional 10% tariff.
I think what's so interesting about the tariff discussion and trade discussions writ large is that Trump is throwing out new countries, new materials like lumber last night, but yet the only tariff that is in place is this 10% additional on China. And you speak to people in the administration, and it feels like an opening salvo when it comes to China. This time around, how different are the negotiations going to be? Because Trump wants to get other things done with China. He wants Xi to put pressure on Putin to get an agreement in Ukraine. He wants the Chinese to stop buying Iranian crude so we can have maximum pressure on Iran. How many different levers potentially could be pulled, include also TikTok, when it comes to maybe a grand bargain deal?
Donald Trump seems to like the element of surprise. And if that's the case, the surprise has been who the more friendly conversations have been with and who the more where the animosity has been with traditional allies of the United States, especially when it comes to this tariff discussion. Watch what he does, because as you say, Annmarie, the 10% tariff has remained on China. The discussions around China and Russia much friendlier than, say, Europe and Canada and Mexico, which just, again, goes to this element of surprise.
For the Ukrainian leader, the discussion's been absolutely scathing. President Trump saying the Ukrainian President Volodymyr Zelensky, quote, better move fast to reach a peace deal with Russia or he will not have a country left. Trump is preparing to meet with the Russian President Vladimir Putin as soon as this month to hopefully, potentially, negotiate a deal to end the war.
Rhetoric has been very hot, not only in that Truth Social post yesterday where Trump called Zelensky a dictator. He also said it yesterday speaking at the FII Investment Forum in Miami. This is what individuals close to the president have said, individuals who are defense hawks, like Mike Waltz. President Trump is driving this very quickly. Some people may not like the order that it's happening, but you have to talk to both sides to get both sides to the table, and that's what we're doing. Kind of saying this is his way to push Zelensky into the peace negotiation agreement to the table. But the rhetoric is very incredibly hot right now.
Here's a take from Peter Trubowitz of the London School of Economics, who has this to say, quote, Trump's declaration is nothing short of strategic gaslighting and should be seen for what it is, an effort to structure the negotiations over the war in a way that is less about guaranteeing Ukrainian security than it is about realigning US-Russian relations. Peter, I'm pleased to say, joined us now for more. Peter, I just want to pick up on that last line and just read it again. It's less about guaranteeing Ukrainian security than it is about realigning US-Russian relations. What guides that view for you, Peter?
I think for Trump, John, good to be with you. I think for Trump, this turnaround, a stunning turnaround, bringing Russia basically in from the cold, has at one level all the trappings of grand theater. It's bold, it's dramatic. To pick up on, I think, a comment that Lisa just made, it's a surprise. But I don't think it's designed really to move the needle closer to a just peace in Ukraine. I think you can look at it as a way to kind of put Europe in its place, as a way to potentially put Russia in play in America's competition and rivalry with China. And I think you can also look at it in partly an attempt or a hope that this will lead to access to Russian energy and minerals.
Peter,
so I think for Trump, on the Trump side here, I think the idea is that Ukraine is part of a larger game.
Peter, though, when it comes to the prior administration, they said Putin did not want to engage. We see almost immediately this administration actually get the Russians to the table. Could this just be a reset of a relationship, a feeling out of what each side wants to do? These are two nuclear powers. Do you think it's important for them to have a dialogue?
Maybe important for them to have a dialogue, but it's pretty easy to see why Putin came to the table. If the American leader is prepared to concede up front many of the things that he wants, Ukraine is not going to be in NATO, there's not going to be American troops in any kind of peacekeeping force on the ground. Remember, Russia has been treated by American presidents, Republican as well as Democratic, as a pariah state for some time now. And Trump has essentially, just take Marco Rubio's words in Saudi Arabia, that they see Moscow as a partner going forward. So from Putin's standpoint, this allows him to kind of get back into the game in a way that I think few people expected.
But at the moment, Russia's central bank assets are still frozen, and there's still a ton of sanctions levied at that economy. What do you think Putin would want to see in order to maybe get this peace agreement that Trump is efforting?
I think he'd like to see a peace that's very much on his terms. That is a peace that, leaves him with a very large chunk of Ukraine, that ensures that there's no long-term security guarantee for Kiev, and that leaves Europe much weaker than it was before these negotiations started. I think whether or not or when he gets the U.S. to ease up on the sanctions, that probably will depend less on what's negotiated over Ukraine than what Putin is offering the United States in this larger game that I'm referring to.
Peter, you keep talking about this larger game that Ukraine is just a part of, and that's certainly the case for Russia. What's the ultimate goal for the United States in this game?
Well, I mean, if you take the officials Trump officials at their word, part of this is to put Russia in play, to kind of do a Nixon in reverse, where Russia becomes an instrument of U.S. policy vis-a-vis China. That they draw Russia in closer, not only with respect to China, but Iran and so forth. I'm not sure how much weight I attach to it. And I think also it's important to keep an eye on the potential strategic implications, the downsides of what Trump is doing. I mean, one of the messages that's being sent here to countries like Japan and South Korea and Poland is, in Trump's world, where might makes right, and American security guarantees are not really that credible, the only way to protect yourself is to go nuclear. That's certainly one consideration. Another strategic downside risk in all this is that if America is willing to accept the proposition that coercion pays in Europe, then perhaps it would be willing to accept the proposition that coercion pays in East Asia as well.
Peter, there has been a real move in Europe to bolster their defense system, in part in response to questions around what kind of U.S. support there would be. Are you saying that this is as much a negative as a positive at a time when a lot of people are saying this is what they needed to do and will actually bolster their economy as well as their defense?
No, I think it is a positive in the sense that, Europe needs to take its own security, meet its own security needs, or at least invest much more heavily than they have in the past. And so, yes, on that level, you could say this is a wake-up call. But it's not obvious to me that Europe is the solution to the problem in Ukraine. I mean, partly the problem here is that the Europeans themselves do not want to be in the role as peacekeepers there. And partly their ability to kind of ramp up on the security front, on the defense front in time is, it's limited. I mean, what you really need are U.S. military equipment and backing. And at the end of the day, if there was going to be a settlement in Ukraine on kind of just terms, you need the U.S. skin in the game.
Professor, appreciate your time as always. Peter Trubowitz there of the London School of Economics. The former British Prime Minister Boris Johnson making the point, alluding to what you've been saying, Lisa, that this was designed to shock the Europeans into action. Certainly doing that. I've got no idea what the objectives ultimately were, but the Europeans were shocked into action more than a decade ago. The original incursion into Crimea back in, 2014?
2014.
And look at them drag their feet over the last decade or so.
It seems as though maybe there is more urgency at this time, given the fact that people are meeting to talk about the financing mechanisms. But it's the reason why there hasn't been a wholesale rally to the extent that a lot of people expected, since it just isn't a sure thing.
Not just the annexation of Crimea, but Novichok used on your own soil, what happened in Salisbury in the United Kingdom. There have been a number of shocks from Moscow into Europe. And the Trump administration would say, you have been well aware of what Putin is like, and you forfeited your seat at the table when you continued to rely on Russia. When it comes to these Europeans, next week, Emmanuel Macron early in the week going to the White House. Later in the week, Keir Starmer going to the White House.
Yeah.
Tons of discussions in this space.
It's the message they've sent repeatedly. Equity futures right now on the S&P negative by about 0.25% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. In the Middle East, Hamas handed over the remains of 4 Israelis taken hostage on October 7th, 2023. The bodies of a young mother, her 2 children, and a man in his 80s were given to the Red Cross. The exchange happened as negotiations for the second stage of the ceasefire are due to start. 6 living Israeli hostages are set to be released on Saturday. Elsewhere in Washington, D.C., President Donald Trump considering returning 20% of the savings from Elon Musk's Doge to American taxpayers. The White House has claimed $55 billion in savings so far, but itemized documents posted by the group suggest the actual savings are far less. Bloomberg estimates that the sending 20% of the roughly $8.6 billion of Doge savings so far would amount to about $11 per taxpayer. And elsewhere, the Trump administration is moving to block New York City's congestion pricing program. The Federal Highway Administration plans to withdraw its agreement with the state, which allows tolls on driving enter some of Manhattan's busiest streets. The city's transport authority has filed a legal challenge to the move. And that's your brief. John.
Danny, thank you. Appreciate it. It was quiet for about 5 minutes, wasn't it, in the early part of this year? And then the roads got pretty busy again.
The roads got pretty busy, and now there's not going to be what Trump would call a regressive tax if you are traveling below 60th Street. And
is this the pitch to the people of Queens?
Well, then he put out, the people of Queens. Some of us are part of the people of Queens. And then he put out this photo of himself with a crown on and said king. And I think he was trying to make the point, I am the king of Queens. My Department of Transportation will rule over your congestion pricing.
Abramowicz looks furious about the whole thing.
It was passed. It was supposed to finance some real developments and changes that would have made public transportation a lot more efficient and cleaner and safer and better. How is that going to get paid for now?
It's nice to take 2 views. Just some balance on the programme. Up next on the programme, the new Trump tax cuts.
The new Trump tax cuts will also include 100% expensing for new factory construction. If you buy something that is going to be good for our country, we're going to let you expense it.
In just a moment, we'll catch up with Gennadiy Goldberg of TD Securities, and in about 15 minutes' time, we'll speak to the Treasury Secretary, Scott Bessent, from New York. This is Bloomberg. In the next hour on Bloomberg Surveillance, we'll be catching up with the Treasury Secretary, Scott Bessent, live and exclusive right here on Bloomberg Surveillance. Do not miss this conversation right here in New York City. Equity futures on the S&P 500 going into that negative by about 0.25%. All is fine and calm in the bond market, the 10-year 4.53. Under surveillance this morning, the new Trump tax cuts.
The new Trump tax cuts will also include 100% expensing for new factory construction in the United States. If you buy something that is going to be good for our country, we're going to let you expense it. We're trying to balance the budget immediately, and because of the tariff income, which is really, it's already turned out to be amazing, actually. It's really meant more for bringing countries and companies into our country.
So here's the latest. So far, so good for the bond market under President Trump. Yields dropping every week for the past month. Gennadiy Goldberg of TD writing, markets retain a dual focus as the year wears on. Economic fundamentals and politics, trade uncertainty has dominated headlines, but immigration and fiscal policy also matter significantly to the market. Gennadiy joins us now for more. Gennadiy, it's good to see you.
Good to be here.
Let's talk about this bond market. Yields are dropping. They're not climbing. That was not the call coming into 25 from the consensus. Your call was a bit different. What are you looking for?
We're still looking for kind of a first half, second half story. I think the first half is all about trying to figure out Trump to some extent and trying to figure out the macro backdrop as well. We have a fairly strong macro economy that is on its way to gradually moderating. And then we've got a lot of the uncertainty on trade, on tariffs, on immigration, on all these things. And that's really going to push us towards kind of a second half where we do think we reassess and rates slowly drift lower over the course of the year.
So right now, range bound as people weigh these sort of counterbalances and remain in a fog where Do you have clarity yet? Do you understand Trump?
I'll put it to you this way. With a lot of my conversations with clients, the conviction level on a scale of 1 to 10 is about a -2. Nobody has any clue as to what's coming next. And really what we're trying to understand is what is the end goal of a lot of these policies. And we're still very much in the thick of it. I mean, it's been a month at this point. It's felt like much longer than that for the bond market, I can tell you. It seems like everything is calm. But underneath the surface, there's a lot of analysis going on, a lot of people trying to understand what exactly is the end goal of these policies. I don't think the market has a good sense of that yet.
Right now, we looked at the meeting minutes yesterday that came out from the last FOMC meeting, and they talked about the uncertainty, the policy uncertainty, and said that generally it pointed to upside risks to the inflation outlook. Do you agree that when you put the soup together, the risk is to an upside bent in inflation rather than a downside swing in growth?
I think if you look at the data you've seen in the last couple of months, the Fed is very much painted by that. They do try to look at longer term trends. The last couple of months have been a little firm, although I will say less firm than expected. And if you look at the translation into core PCE, we're still looking for a 0.25 on a month-on-month reading just next week. So we're not really seeing this massive reacceleration of inflation that folks are worried about. So I think we're still on a downward trajectory. The issue is it's not downward enough for the Fed. They want it to be making more progress. And I think that's what's got the bond market a little stuck.
It's not lower enough for the Fed, and it's not lower enough for the Treasury Department. And we're going to be speaking with Scott Bessent, who talked about how he is focused on the 10-year yield. How much control do you think the Treasury has over this? How much will their issuance plans, as well as just how they offset some of the spending, how much is that going to really be the main driver for where the 10-year is?
I think the focus from this administration is well received by bond markets. I can tell you that much. There's a lot of, I would say, of the fact that he is looking at the long end of the yield curve and saying, what can we do to ensure that there's ample supply demand? Maybe that means once November comes around, which is when we expect auction sizes to increase, maybe they moderate the increases in the long end. Maybe they don't even increase 10, 20, and 30-year auction sizes. That's something that's potentially on the table. I doubt that would have been on the table with prior administrations. They would have tried to raise it on all venues. Here, we're really looking at where is the kind of the optimal issuance point with the keen kind of point of let's try not to increase rates further out the curve. Term premium is already higher. So that's something that the U.S. taxpayer has to be paying for, and they're really trying to minimize cost to taxpayers. That's really the Treasury's goal.
What can they do in the short term, though, if they're laser focused on bringing down the 10-year?
I mean, get the budget in order. I mean, that's really the next big thing. And
so not send out $5,000 checks?
It would be use $5,000 checks to pay down the deficit, right? I mean, that would be kind of the best thing that's received by the bond market so far. I mean, if you really want to do this, we're running about a 6% deficit to GDP. Bring that down. I know there's a lot of efforts to do that at the moment. We'll have to see what the results of that are. I don't know if the bond market is fully convinced that lower deficits is the direction we're heading, and to what extent they're going to be lower.
It's early days, but yields are falling, not rising. And that's the change that not many people expected coming into the new year.
I love what Gennadiy is talking about in terms of the analysis underneath the hood of all of these potential policies and how they offset each other. And right now, the focus is more on what this could mean for a growth hit, more than, say, inflation.
Gennadiy, it's good to see you. As always, appreciate your time. Thank you, sir. Gennadiy Goldberg there of TD Securities on this bond market. In the next hour, absolutely stacked programme for you. US Treasury Secretary Scott Bessent joining the programme alongside Libby Cantrill of Pimco, Bob Elliott of Unlimited, and a whole lot more still to come this morning. The big focus this morning, without a doubt, on the bond market.
Absolutely. On the bond market, there's an individual who says that actually what regulates him and the president, maybe not so much the stock market, it's where the 10-year yield is. But what can they do to get the 10-year down if they're still issuing at the same caliber that Janet Yellen was?
Uncertainty in the markets hasn't translated into the stock market and hasn't translated into the bond market. How much has that given them leverage to not necessarily be concerned?
Bond yields just about unchanged this morning. The 10-year 4.53. The second hour of Bloomberg Surveillance up next.
It's time to really start thinking about how to work with this administration.
You're supposed to take Trump seriously, but not literally, and that's what I think we've seen in the market.
The market is basically making an assumption, right or wrong, that these tariffs will not go into play.
The ultimate revenue raiser is going to be that smaller than expected, but more permanent tariff that goes into effect.
So far, what we've heard from Bessent is that they've had Elon Musk and his team have found $50 billion in deficits savings, but that's far from the $2 trillion that they're targeting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now with equity futures on the S&P 500 negative by just 0.25% following back-to-back all-time highs. On the Nasdaq 100, the equity market negative by just 0.25%. We begin this hour with the self-described nation's top bond salesman. He's worked alongside some of the most well-known investors on the planet, including Jim Chanos, George Soros, and Stanley Druckenmiller, going on to build a highly successful investment career, betting on and against the decisions made by the people sitting in the seat he now occupies. Joining us for a conversation live on Bloomberg TV, the 79th Secretary of the Treasury, Scott Bessent. Secretary Bessent, it's good to see you, sir.
Jonathan, good to see you.
A warm congratulations from all of us to you. Quite an arrival from, what was it, Little River, South Carolina?
Yes, it's an American success story, only in America.
To the office of Alexander Hamilton with some unique experience. How is that going to help you, sir, approach some of the challenges in this economy?
Well, Jonathan, the way I look at it, for my career for 35 years, I've been sort of sitting outside the room with my ear up against the door or trying to look over the transom, trying to figure out what policymakers should do or going to do and how that would affect the markets. Now I'm inside the room trying to figure out what everybody outside the room expects us to do, how the market's going to react, and what the economic and market implications are short term, but more importantly, medium term, and how that's going to affect the underlying economy.
We've got a lot to discuss, so let's start with the debt market. What people expected you to do, maybe, was change some of the issuance for Treasury. Something that you'd said back last summer about then Secretary Yellen was that Yellen had taken control of monetary policy through Treasury issuance. Then you're basically maintaining her plans. Can you help explain that? Help us understand where you're coming from.
Sure. So the previous administration shortened some of the duration, and we haven't shortened it further. We've just kept the policy in place. And I believe over the medium term, it's going to play out as it becomes clear that everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Jobs Act is made permanent, then we can have a revenue increase, cost decrease. And as you said, as the nation's top bond salesman, I got a pretty good story.
So what's the medium term? Help me understand that. What is the medium term? And then once you see all those things, let's say those ambitions become reality, then do you start to think about terming out the debt?
Sure, but that's a long way off. And we're going to see what the market wants. As Lisa noted this morning, and it's fun to see someone who believes that Fed minutes are exciting. That the Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller.
So when do you think that time would be? End of the year or further down into the administration's term?
Yeah, it's going to be path dependent. We're still seeing sort of the residual Biden inflation that's still coming through. And I think as the market starts to realize what we're doing and inflation starts to drop, then we will see. So it's going to be path dependent. That's the eventual goal, but I'm not going to signal it now.
When you mentioned the Fed minutes, participants indicated yesterday that one of the problems they had was they were waiting for Trump policies to come into place. Do you think that those policies, when you think of tariffs, potentially deportations, immigration, this can be inflationary? Is it going to hold back the Fed from cutting rates?
Well, To the extent that team transitory at the Fed is still has any credibility, I would say that tariffs, if they have any price adjustments, are the most transitory thing there are. So I don't think that should hold them back very long. And I would point out that depending on what number you want to use, 10, 20 million people who came across the border, we had the worst inflation in 40 years when we added 10 or 20 million people. So I'm not sure why people are saying that it's inflationary to tell them to go home.
So when you look at team transitory, do you think the next move for them would be a cut?
Annmarie, I have said publicly that I will talk about what the Fed has done. When I was a market commentator and investor, I would talk about what they should do. Now I will leave it to them, and Chair Powell and I have a weekly breakfast. We saw each other yesterday, and I will convey my thoughts there.
Well, let's talk about what they have done. We can comment on that. You said you're willing to. They cut rates 100 basis points going into the end of last year, and an odd thing happened. Yields at the long end rose, they didn't decline. Do you think Federal Reserve easing contributed to higher long end yields?
Well, Jonathan, I would just say the point of cutting rates is to cut rates. So if they cut rates and rates went up, then there probably was something there. I thought that the rate cut in September, I said it maybe even on your show here, that it was oversized. The market responded, but now we're seeing term premium come back down. So we'll see what happens from here.
Do you think the current rate right now is enough to bring down 10-year yields over time just by virtue of being restrictive?
Again, I'm not going to comment on current policy.
I am curious. You talk about how you do look at the 10-year yield every single day. I love that. I love that you're the top bond salesman in the United States. And I'm wondering, are you expecting it or hoping it to go down from here? Is that necessary to achieve your 3% growth target?
Well, what's necessary are the underlying conditions. So the underlying conditions that we need for yields to come down, for growth to go back up. We've got this affordability crisis in housing. We've got an affordability crisis in the auto payments. So one thing that would be very stimulative, and as Jonathan mentioned earlier, the 10 years come down, or rates have come down every week since Donald Trump's been president. So if we can continue that for 52 weeks, that'd be great. And it'd be it would be a win for the American people, which at the end of the day, that is our goal. So if we do what we say we're going to do, if we can rein in the budget deficit, if we have non-inflationary growth, if we bring down energy prices, and I think now that I have the numbers on the inside, there was a big contributor to this massive inflation was regulation. I think you said earlier this morning that what if these things cause inflation? As Annmarie just said, some of the policies. Well, what really happened under the previous administration was you created a demand shock with government spending, but it was met by supply constraints as there was more regulation. In Trump 1.0, we created a demand shock with tax cuts, and it was met by supply side response of less regulation. So, the Biden administration created this inflation that a demand shock and constraining supply is the ultimate recipe for inflation. So.
And now you want to cut spending. The Doge program, let's talk about it. You've called it one of the most important audits to government ever. You remember that Clinton tried something similar, the National Partnership for Reinventing Government. How different will this be? And what kind of cost savings are you and the team thinking about? Yeah,
and Jonathan, I can go all the way back. Given my tenure in the business, I can go all the way back to the 80s to the Grace Commission. And they had some great ideas, most of them not implemented. I think that the Clinton-Gore initiative, I think a lot of that was academics. So this is people on the ground, all areas of government, and it's moving quickly. And I really do think it's unfortunate that it's been lampooned and attacked the way it has. But when it's being attacked like this, it tells me that there are a lot of entrenched interest in terms, when you're moving people's cheese, They don't like it. And it's not their cheese, it's the American people's cheese.
Well, how about putting some of that cheese back into American people's pockets? How inflationary would those $5,000 potential Doge checks be that the president spoke about yesterday?
Well, I think, again, that if we are bringing down energy prices, if we are cutting the regulation, so I think that it's to quote the vice president during the campaign, I think it's holistic, and I think that it's all kind of one mosaic. If you were to inject a lot of money into the economy, because Annmarie, think about this, that we are at this massive deficit to GDP, 6.7, almost 7%. So what will be happening on one side? You'll be bringing down that spending in the economy. So, very easy mental model is every 300 billion is about 1% of GDP. So every 300 billion that Doge is able to save, could you put that back in the economy into people's pockets?
One thing potentially that could happen, and people are questioning it, is maybe remarking gold. Elon Musk, who's leading Doge, was talking about maybe going to Fort Knox to make sure those gold reserves are there. That comes under your purview. Do you have any plans to visit Kentucky?
I don't have any plans. I can tell you that we do an audit every year. I can tell the American people on camera right now that there was a report September 30th, 2024. All the gold is there. Any U.S. senator who wants to come and visit it can arrange a visit through our office.
Gold was your biggest holding when you were a hedge fund manager before you divested to become the Treasury Secretary. So you know the value of where gold is right now versus where it's marked on its balance sheet, just north of $40 an ounce. It's close to $3,000. Is it under consideration for this administration to revalue gold?
I think that somehow when we were talking about the sovereign wealth fund and I said monetize the balance sheet, I can promise you that's not what I had in mind.
So it's not under consideration, not on the table?
That's not what I had in mind.
When you look at the Doge savings that you have so far, how much is that going to go to offset some of the tax extensions that we see? What other savings are you looking at that potentially are crucial?
Well, again, they're just getting started, and one of the shocking things to me has been, when we talk about waste, fraud, and abuse, we all think of what comes out of D.C. We think of some waste and fraud and friction costs, because one way to think about this is 25% of the U.S. economy flows through Washington, D.C. So if we can cut the friction on that, that's a lot of savings. What we are discovering now, in waste, fraud, and abuse, there may be much more fraud going on than we thought. And I think you're going to be hearing about that over the coming weeks.
Can we hear about it now?
I think you're going to be hearing about it over the coming weeks.
What kind of fraud are you thinking about? What kind of fraud have you identified?
Again, I'd refer you to some.
Well, you're here now, so I want to see some of it out of you.
I'd refer you to some of the statements by Lee Zeldin at the EPA.
Okay. Well, we can build on that in the weeks to come.
Great.
I'm going to refer to you some comments from the Washington Post on defense cuts. They're reporting that Pete Hegseth, the defense secretary, ordered senior leaders at the Pentagon and throughout the US military to develop plans for cutting 8% from the defense budget in each of the next 5 years. Are you aware of that plan?
I'm in contact with Secretary Hegseth, and we're working very closely. And, again, I'm not going to jump the gun here on TV, but I think everything's on the table, and can things work more efficiently?
When it comes to the defense budget, we spent more last year on our interest payments than defense. So are you hoping for 2025 to spend more on defense than the interest payments?
Well, it would depend how we got there, too. Does defense spending go down? Does the interest bill go down? We'll see what that calculus is.
Got to focus on tariffs too. Revenue raising is a part of that story. Reciprocity, national security. You want fair trade. I think we all want fair trade. The president has discussed reciprocal tariffs. He's mentioned the Europeans also offered to drop auto tariffs. Could we start there? Have the Europeans actually made that offer? Can you confirm that?
I haven't seen that, but it's possible. I think that good thing about President Trump's negotiating style is people put things that were not on the table before on the table very quickly.
So that would be reciprocity and maybe negotiating. But to offset the tax cuts, where's the revenue raising?
So there could be, not everyone is going to give on every point, right? So the Europeans seemingly put forward very quickly auto tariffs, but not every country is going to do that. My view, as I've said before, China is the most unbalanced economy in the history of the world, and they are trying to export their way out of what is a very serious recession, and the rest of the world can't do that. They can't dump Chinese goods. They're going to have to rebalance their economy. So tariffs on Chinese goods went up 10%, and a lot of that, again, Mexico, Canada, China, that was in response to the fentanyl crisis.
China's the only one, though, that those tariffs have actually stayed in place. Is that the opening salvo? How high do you think Trump wants to go when it comes to Chinese tariffs?
Well, I'm not going to give away his negotiating hand on TV. I do have my first call with my Chinese counterpart tomorrow morning, so I look forward to a very productive discussion.
What's the first point you want to bring up?
That we want to work together. And as we've said, a lot of the precursor ingredients from fentanyl originate in China. So we really want to put a stop to that very quickly.
Historically, there's been some currency concerns with regards to China as well. In the conversations we had you before taking up this post with you, you mentioned that some countries, some currencies are undervalued. Is China one of them? Is that something you'd like to remedy?
Yeah, well, Jonathan, what I've said is, make no mistake, the U.S. still has a strong dollar policy, but that does not mean that bilaterally other countries can weaken their currencies versus the dollar or manipulate their currencies. So, but specifically on China, China's a very difficult currency to value, because I really think that when we think about the value of the RMB, it's in three different equilibrium. On any academic model, say purchasing power parity, it's cheap. On the other side, you have 1.4 billion people who are subject to capital controls, and they want to get some of their money out of the country. And then you have what I would call the X factor. If you put money into China today, what's your belief that you will get it out in 2, 3, 4 years? So it's very difficult to come up with a point value of the currency.
You've talked about the desire to have a strong dollar policy for the United States, but is a strong dollar at odds with the idea of bringing industrial production back to the United States, and sort of speaks to some of the concerns about other countries trying to devalue their currencies?
Well, I think that we will necessarily have a strong dollar if we run good policies, and I think we're going to run good policies. If we cut the trade deficits, when you think about the trade deficit is a combination of terms of trade, value of the dollar, and our own budget deficit. So if we bring down the budget deficit, then I think everyone, if we are deregulating, if we make the tax cuts permanent, if we make the U.S. more business friendly, then all the reserve managers in the world, all the private investors are going to want a piece of that, and the dollar will be strong, but we will be able to push back on that through good policies, through productivity. The U.S. productivity, I think, I've been meeting with a lot of the tech leaders lately, and I think we are very close to the cusp of this AI finally coming into the productivity numbers.
Do you think that a strong dollar is necessary in order to offset some of the costs that could be otherwise associated with the tariffs?
Traditional economic theory would tell you that the dollar strengthens on the tariffs, but who knows what we've already seen since the dollar appreciation since November 5th. Markets live in the future, so have we already priced in some of that? And on the other side, what we are trying to do is to get other economies to successfully rebalance. My conversation tomorrow with and this is really just an introductory conversation, but as we go down the road, the Chinese need to rebalance their economy in favor of consumption. that they are suppressing the consumer in favor of the business community. So, as that happens, then they will increase their demand. Same thing in Europe. Mario Draghi, for any of your viewers who didn't see it, Mario Draghi had a fantastic editorial this weekend in the Financial Times where he said, look, we have put the equivalent of more tariffs on ourselves, more tariffs on ourselves than the U.S. could ever contemplate. So could you get a very strong euro if somehow they had an immaculate deregulation?
Just quickly, you're having this call with your Chinese counterpart. Will you see him next week at the G20 finance ministers meeting?
I'm not going to Cape Town due to some domestic considerations. I actually think that he's not attending either.
You don't think is that what he's told you?
This is the readout that we've gotten.
Okay.
So, and again, I also believe several of my other counterparts won't be there. I have been speaking and in contact with them regularly, and then I will be seeing them at the spring IMF World Bank meetings in D.C.
Wanted to talk to you about national security as well, and the dollar has certainly got a role to play on that front. The sanctions policy of the United States. As we look back, do you think that's been misused, abused?
Yeah, excellent question, Jonathan. When I came into Treasury, if you think about sort of Treasury is five pieces. There's IRS on one side, the Mint on the other, but the main focus of in the building at Treasury is domestic finance, international finance. That's what I've been doing for my career for 35 years. I was able to hit the ground running on that. What we call TFI, terrorism finance, is where my biggest learning curve is. So I'm spending a lot of time on that, and I'm reviewing the sanctions policies. Why do we do what we do? Have they been effective? Are we running a 21st century program as opposed to some outdated modalities?
Well, the current sanctions are in place on places like Russia to try to get Putin to a negotiating table. You are intricately involved in this deal. You were just in Kyiv. You met with President Zelensky. Trump yesterday called Zelensky a dictator without these elections and said that he better move fast or he's not going to have a country left. Does this language make it harder for you to get that minerals deal over the finish line?
Well, look, I think President Zelensky, unfortunately, escalated and has put some daylight between.
How did he escalate?
A lot of his remarks in Munich, I thought were inappropriate. President Zelensky, when I met with him, assured me that he'd be signing the minerals deal in Munich. He has not. And look, the real purpose here, and I think it's turned into kind of this media circus, that President Trump had a very elegant plan, and it was bring the Ukrainians closer to the U.S. Let's do this economic deal. And even Karl Rove in the Wall Street Journal this morning approves of it, that the U.S. with greater economic interest in Ukraine provides a security shield. So the sequencing of what was going to happen was bring the Ukrainians closer to the U.S. Through economic ties, convince the American people and the American public, get them on side, and then tell the Russians, go to the negotiating table with a very fulsome message that if we need to, we will take sanctions up.
Well, what about tapping the Russian frozen assets, some $300 billion? Would you force your European counterparts to not just have them frozen, but actually tap them? Trump talks about repaying the American taxpayer. Shouldn't Russia be a part of that?
Well, what's happening now is they are being tapped. So the returns from
the interest,
the returns from the freezed asset pile is going to pay the Europeans. What's very important to understand here is that everything the U.S. has done to date, the American people, the American taxpayer, is grants. The Europeans, roughly half of what they've done are loans, and the runoff from the frozen assets is being used to repay European loans.
Have you communicated that to the Europeans, that you're upset with them?
What's that?
Have you communicated to the Europeans that you're upset with them?
I think Vice President Vance did a pretty good job in Munich.
Do you think they understand that the United States is running a deficit of north of 6%, close to 7%, and that the budget for defence is north of $800 billion. Do you think they understand the gravity of the moment in the United States, the US perspective?
Look, I think that they understand that President Trump, during his first term, this term, Vice President Vance, and the entire security apparatus have told them that many of the countries are deficient in their NATO spending, and they need to come up. When I went to Ukraine, you fly into Poland. Poland is spending almost 5% of GDP on defense. And look at Poland sitting next to Ukraine. Poland is one of the great economic success stories of the past 30 years. After China, they've had the fastest growth. So why couldn't Ukraine, with some U.S. capital, ingenuity, know-how, and root out some of the corruption, do as well as their neighbors done?
If Europe spends more, will it allow America to cut back on defense spending? Is that the ultimate goal?
The ultimate goal is for the Europeans to come up to where they've said that they are going to, and to provide their share of the NATO spending.
You mentioned sanctions. So do you have both on the table ready to go, a sanctions ramp up or wind down on Russia, depending how these talks go?
I think that'd be a very good characterization.
When it comes to the talks, Trump still thinks he's going to meet with Putin, he said, probably by the end of the month. The end of the month is next week. Are you preparing for that?
I'm not going to give away the timetable, but the president is committed to ending this conflict very quickly. And I will tell you, you're in Kyiv. I went to a children's hospital that had been bombed. And this was not a children's hospital where you take your child if he or she scrapes their knee. Like this was.
So you can imagine. I did that trip that you're talking about just a few months ago. You can imagine why they haven't had elections then, right? They're living in this martial law.
They are, and it's probably necessary to move forward with the democratic process.
We've covered a lot of topics. One name that has not come up very much is Elon Musk. Let's finish there. You've had some tremendous colleagues in your experience over your career, including the great investor Stanley Druckenmiller. You've worked alongside Donald Trump through the campaign. Can you just describe what it's like to work with someone like Elon Musk, someone as successful in American business? Just what's that like day to day?
Yeah, look, Elon Musk, like Stan Druckenmiller, I always compare the great business people to great athletes. They keep their eye on the prize. Whether he's the Messi or Michael Jordan, he is focused, and his energy level is unbelievable. And he's gotten to where he has because everything's on the table. There's always this examination of why are we doing it this way? Why are we doing what we're doing? And most of all, if something's not working, let's fix it.
Sam Altman was on Bloomberg TV just 2 weeks ago and called Elon Musk insecure. Do you view him as such?
I'm not going to get into the tech magnate. Kind of slap fest.
Secretary Bessent, I would say that's wise.
Yep.
He is drawing criticism, though. When you and the administration come out and pick out the various things where money has been wasted on, I think we can all agree that that's a waste of money. Where there might be some concern is the way that some people are being laid off in Washington, that it lacks some dignity. Could you comment on that today?
Look, I think that there are many fine public servants, but I think that I've been in Washington 3 or 4 weeks now, and there's a real bias towards the status quo. And if you don't move quickly, then the lobbyists get involved, the entrenched interest, and it's impossible to get anything done. So anyone who has experienced financial hardship, any kind of the mental duress, I'm sorry for them, but that's also what the average American experiences every day. Most of us, you all come to work. You want good ratings. You get a performance readout. You really push forward. And I can tell you that in Treasury, I have been so impressed with the quality of the permanent staff. And I want to get everybody back to the office. And a lot of people are on board with that.
When it comes to your prior life, you didn't have a boss. You said it would be like atrophy if you weren't trading financial markets every single day. What is it like now to be in this position where you make decisions that people can trade against what you're doing, and you also have a boss that sits pretty close to you in terms of the Treasury Department and the West Wing?
Well, look, I only had my own firm for 8 years. So I worked with Mr. Soros, with Stan Druckenmiller, and it's a great feedback mechanism. And I think I have the best position in D.C. I'm on the White House campus. We have a great staff in Treasury. I can be in the Oval in 4 minutes. And so there's proximity. And again, not like Elon Musk, President Trump is committed to shaking up the status quo. He came in with a mandate, and he's moving on it very quickly.
You're a total gentleman, and you've been very gracious with your time. Thanks for being a good friend to this programme over the last year. Secretary Bessent there of the Treasury. Secretary Bessent, thank you, sir.
Good to see all of you.
Appreciate it. Thank you. Let's turn to the market. I think that Scott might be happy with this one. Bond yields are down by a couple of basis points on the 10-year. We're down to about 451. On a 2-year, we're just about unchanged at 426. Tyler Tendall is down in Miami for us. Tyler, welcome back to the programme. We're not terming out that debt for quite a while. The message from Scott Bessent, the Treasury Secretary.
Right, John, numerous headlines out of this, particularly when we're talking about that deficit, also the debt limit. I was struck by how he said he's going to have that first conversation with his Chinese counterpart tomorrow, particularly as we hear tariffs at this conference here at FII take center stage. Even President Trump yesterday floating increased tariffs up to 25% on lumber, particularly as we look ahead to this timetable that he said of April 2nd for additional tariffs on chips, pharmaceuticals, and autos that could hit Asia pretty hard.
Tyler, what are we expecting today from the president? He left Miami. He's back to Washington, D.C. with a full schedule.
Right, Annmarie. Well, first at 3 p.m. Eastern, he's going to be hosting an event celebrating Black History Month. Then he's going to address the governors of the Republican Party who are convening in Washington for this sort of summit to talk about their plans going forward. A lot of President Trump's rhetoric around what he's doing when it comes to the federal government, particularly DOGE, as you were just talking about with Secretary Bessent there, has to do with giving more control back to the state. So we're expecting that to be one of the big focal points. You heard Secretary Bessent there say that Elon Musk's energy is unbelievable. Also talked about some criticism when it comes to letting go of federal workers, saying that in many cases the government believes that this is necessary. But I've spoken to Republicans who have heard critiques from their constituents around the country that are getting hit with these federal workforce cuts. So whether or not that could be something that Donald Trump talks about with his Republican governors today, how states are going to be responding to what could be widespread federal workforce cuts across the nation.
But potentially one sweetener to that is something Trump talked about yesterday in the arena you're standing in, Tyler, and that was these DOGE dividends. What is the president's thinking on this concept of a plan?
Right. Well, he said that he got it from Elon Musk, who, of course, was sitting center stage yesterday as Trump addressed the FII summit. He floated a potential calculation for that it could be 20% back to the taxpayer, 20% back to cutting down on the deficit. But that's going to be very difficult when we look at it in practice, particularly as DOGE has said that they've found $55 billion in cuts over the past month. But according to documents analyzed by Bloomberg News, it might be less than that. So still big questions remaining. And there's a lot of big spending questions that are about to come to the forefront, particularly in Washington, as Republicans try to move forward with President Trump's fiscal agenda. We know President Trump has now now backed this one bill plan from House Republicans. Just quickly, the math on that calls for $1.5 trillion in spending cuts. That is not enough for many fiscal hawks, and it's raising questions while President Trump has said that he won't slash Medicaid. For example, that bill calls for potentially $880 million in slashing Medicaid if it were enacted in its current form. So negotiations are going to get underway here, particularly as that bill also $4.5 trillion in tax cuts. Annmarie, I'll just point that out because that is only about enough runway to extend President Trump's 2017 tax cuts. That means that Republicans are going to have to talk a lot more about savings, a lot more about pay-fors in order to enact the rest of President Trump's tax priorities.
Hey, Tyler, I appreciate your time. We'll touch base with you a little bit later this morning. Tyler Kendall there, down in Miami. Joining us around the table this morning, Libby Cantrill of Pimco. Libby, welcome to the programme.
Thank you.
Let's talk about what we just heard from Treasury Secretary Scott Bessent speaking just moments ago on inflation. Let's take a listen.
Everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Job Act is made permanent, then we can have a revenue increase, cost decrease, and as you said, as the nation's top bond salesman, I got a pretty good story.
Libby, has he got a good story to tell?
Well, he is the consummate bond salesperson. Always nice to be following the Treasury Secretary, by the way. So thanks, guys, in terms of sequencing. I mean, look, I think he very much, as he has inclined to do during his confirmation hearing and subsequent interviews, very much sort of stuck to his talking points, talked about the path to deregulation. That is something that the administration can control. Of course, inflation is somewhat out of the administration's control, as they are sort of experiencing right now in terms of some of these hotter prints. But I think he's stuck to his story, talked about deregulation, talked about productivity increases. In terms of the things that I think the market really will care about today, talked about a strong dollar policy, talked about the independence of the Fed. So in terms of, again, kind of staying in his lane and not kind of spooking the markets, did a great job.
He did the opposite of spook the markets. He came out and he said the idea of terming out the debt is a long way off. He has kept in place a lot of what Janet Yellen had put in terms of the issuance mix. How much is that almost the key thing that people are looking for out of the Treasury right now?
Yeah, I mean, I think it also is just an acknowledgement of the fact that any real deficit reduction that we may see under this administration is likely going to be a 2026 story, not a 2025 story. And that's partly because of any sort of spending cuts that we see through DOGE won't really materialize until 2026. But I think more importantly, we are not going to see congressional action on spending cuts until probably later this year, and that will be effectuated again in 2026. So in terms of just his flexibility of kind of managing the maturity of debt issuance, he has a lot to do just this year, again, just because we're expecting deficits to really running pretty much, consistent where they are, about 6.5% of, debt to GDP, deficit to GDP.
One thing that's so fascinating about this moment is it seems like economic theory is being tested in a multitude of different ways. And one thing that Secretary Bessent said was regulation is inflationary and deregulation is disinflationary, and that will help when you start to strip away some of the regulations that have been constraining the business side, the supply side. How much have you seen that be borne out?
Well, so, Elizabeth, what we're telling our clients is that, again, a lot of this in Washington has longer tails than I think policymakers would like, especially a new administration who are biased to action and who would like to see change immediately. Deregulation takes a while, actually, in terms of what the president's doing, and, from an executive order perspective, trying to roll back some of the things that President Biden had done via executive order. He can do that immediately. But in terms of real deregulation, again, that takes a year, if not years. You have to get your folks in place. What we're telling our clients, though, and what I think the market has been responding to, is more of an absence of new regulation, just clarity around the regulatory, kind of the rules of the road, if you will, and not necessarily looking behind their shoulder, worried that a regulator is going to come and, and enforce against them. So I think that is more what we've sort of seen, the kind of the tailwind. Now, as it relates to growth, as it relates to productivity increases, as it relates to bringing down inflation, I do think that's sort of an open question. But I think what they are and what the Treasury Secretary was saying is that they are trying to do everything that they can, pull all of the levers that they can. But again, there are some constraints. And one last thing I'll just say, the Secretary of Treasury didn't necessarily talk about, and no one in the executive branch is totally talking about, but a lot of this does come down to Congress. And even though Congress has been giving the executive branch a very wide berth, right? President Trump's approval ratings are very good. They want to, give them all the flexibility kind of in the world, if you will. A lot of this will come down to congressional action, real spending cuts, obviously tax cuts. All of that is in the purview of Congress, not the executive branch.
Which is why I was trying to ask him about what he meant when I talked about gold reserves, when he talks about monetizing the asset side of the balance sheet. Is there a way they can get creative so that they can have a $4.5 trillion deficit and have every tax cut they're dreaming of?
Yeah, well, and I thought it was a great question, and he did clarify, right? He did say that was not.
He didn't exactly say no either.
I mean, yeah, well, and I think obviously preserving optionality, right? I mean, which politician would not want to do that? I mean, I think the reality is if you just look at the budget math, again, some of what Elon Musk and the Doge team are doing. Maybe it moves the needle, but it moves the needle kind of very slightly in terms of like the real kind of either revenue raisers or the real kind of spending cuts. Spending cuts you do have to eat into entitlements really, and I think that's going to be more difficult given these slim majorities. But on the revenue side, it's either tax increases, which obviously is not going to happen, or it's really tariffs. And I think this is something that he has alluded to. He talked in earlier interviews about raising $2.5 trillion a year from tariff revenue. I mean, that's a huge increase in terms of our effective tariff rate. So you would have to see pretty significant tariffs for that to come to fruition. But I do think it's revealing that the administration is viewing this as a huge revenue source. And if you look at the numbers, I mean, it could add up, but again, it would necessitate a rather large tariff increase.
Just a message for the gold bugs as well. The gold is in Fort Knox, we're told, apparently. I'm not sure if they'll be convinced by that, but we're told it's there.
I feel like at some point Elon Musk is just going to have to go there and take some photos
with a
and
camera.
post on X. Yeah,
and do a documentary on it.
Yeah,
then people will just say it's tungsten dressed up as gold.
Well, right now, why is everyone worried about gold? People are worried about it with the Bank of England. People are worried about it in the U.S.
Because why are bars being shipped over to the United States? People are thinking, are they actually there?
It's taken a while to get it out of the Bank of England. I understand why. It takes a while to get it out of the Bank of England.
Do you really believe that there are people with their
what I believe.
Rimowas
I'm just saying
and
that
bars of gold?
You have to line up. You have to book a slot to get the bullion.
I know. All right. So have you done it so far?
I have not done that. My gold's still there. I don't have any gold. Why do we always bring up my gold?
It's in your basement.
It's no gold.
He brings his gold bars to work.
Yeah, exactly.
Libby, let's finish on the debt market. I think for you and the team, there was a big focus coming into this year. We'd heard the complaints from the incoming characters in this administration that they were unhappy with Treasury Secretary Janet Yellen at the time for issuing so much at the front end of the curve. I don't see any sign of a change coming anytime soon, do you?
No, that's what, we were just talking about. No, I think he was pretty clear that this is not going to be until later in the administration. And again, just in terms of the financing needs, the new financing needs, the rollover debt that's actually maturing. They just don't necessarily have a lot of flexibility in terms of debt management. And so I think that it looks like 2025 is going to be very consistent with 2024.
Which is the reason why you're seeing people actually have a bid into the 10-year. I'm just wondering at what point the Treasury runs out of levers to pull if you do get some sort of inflationary spike in some capacity. Is that sort of the ultimate call on what we're seeing in terms of the Trump policies?
Yeah, again, open question. The other thing that the Treasury Secretary didn't necessarily talk about, I don't believe, but will be right around the corner is just the debt ceiling increase as well. And so I think that this sort of combined with, again, a lot of debt issuance combined with, maybe a little bit more of a frothing market, it does sort of all point to the fact that he just doesn't have as much flexibility as he was hoping to.
Libby, appreciate your time, as always.
Nice to see you guys.
He was the warm-up act.
Thanks, guys, right.
You know that.
Right.
Libby Cantrill of
Cherry
Pimco.
on top, right.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A quick check on Walmart shares dropping 7.4% in the pre-market session. It forecast lower than expected profit for the full year. Expectations were high, with Walmart gaining share across various areas of business and income cohorts. Walmart's conservative forecast, though, suggests that uncertainty in the economy is hitting the company's outlook. Several U.S. Department of Agriculture employees tackling the bird flu outbreak were accidentally fired over the weekend. The USDA is working to correct the situation and is continuing to hire frontline workers to ensure food safety. The outbreak has affected roughly 160 million birds and taken a toll on the U.S. poultry and dairy industries. An Airbnb co-founder plans to donate $15 million of factory-built dwellings to victims of the LA wildfires. The prefabs made by the billionaire startup will first go to low-income residents whose properties burned in the Altadena and Pacific Palisades. The homes can be built in as little as 5 months and require only weeks to install. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, Scott Bessent's push for lower bond yields.
Rates have come down every week since Donald Trump's been president. So if we can continue that for 52 weeks, that'd be great. And it'd be it would be a win for the American people.
The Treasury Secretary still in my lines. Bob Elliott of Unlimited joins us next from New York. This is Bloomberg. Live from New York, welcome back to the programme. Equity futures right now negative by 0.25% on the S&P 500. In the bond market, yields declining by 2 basis points. The 10-year 451.31. Under surveillance this morning, Secretary Bessent's push for lower yields.
We need for yields to come down for growth to go back up. Rates have come down every week since Donald Trump's been president. So if we can continue that for 52 weeks, that'd be great. And it'd be it would be a win for the American people if we can rein in the budget deficit, if we have non-inflationary growth, if we bring down energy prices. Now that I have the numbers on the inside, there was a big contributor to this massive inflation was regulation.
So here's the latest this morning. Treasury Secretary Scott Bessent affirming his plan to lower rates and rein in spending, but saying the terming out of the nation's debt issuance is a long way off. Bob Elliott of Unlimited joins us now for more. Bob, good morning to you, sir.
Good morning.
I'm sure you followed that conversation. I think there was a lot of interest coming into this year about what they would do with the maturing debt and whether they would term out the debt ultimately. Some pushback there. I think the other thing coming into 25 everyone was focused on were the factors that would lead to higher yields, not lower yields. What's changed in the last month?
Well, I think they are facing the reality of the situation, which is terming out the debt is going to raise interest rates and create a financial tightening that they're not that interested in having in the circumstance, and particularly as they enter what is going to be pretty fraught negotiations about what the policy picture looks like with the extension of the tax cuts and the possible pay-fors that have to happen there. So they want to keep things calm as they possibly can. And, whether they lose a little credibility along the way, given their past comments, they're willing to take that to keep bond markets stable right now.
As an investor, how much of a lodestar can that be? That essentially if Treasury Secretary Scott Bessent cares about the 10-year, then everything's going to be just fine, and that can be your benchmark for how you invest going forward, that long-term rates aren't going to spike higher. How much is that sort of a base case that you can bake in?
Well, I think the main question is how is he going to get lower rates? He talked about how rates had fallen each week of the new administration. The question is that happening from disinflation, which is what he was arguing, or is it actually happening from a repricing of growth conditions? Right? You talk about pay-fors that have to come with a TCJA extension. You talk about tariff increases. You talk about cuts, federal government cuts of employees and other spending. All of that is negative when it comes to nominal growth. That's why bond yields are falling. And that is, in many ways, not a good reason for bond yields to fall if you're trying to, support an economy.
So this is something that we were talking about with John Stoltzfus. He said that this is maximum policy uncertainty right now, and that's leading to people getting concerned about what a growth shock would look like in addition to inflation. From your perspective, is there a consequence to the uncertainty that we're seeing in markets from an investing perspective that actually is affecting what you're buying and what you're not?
Yeah, well, I think for most people who are thinking about businesses are thinking about what are they going to spend on, what are they going to invest in. There's so much ambiguity here. Imagine you're a U.S. automaker. Is the tariff 25%? Is it zero? Is it happening? Is it not happening? Certainly all of that is creating disruption in the overall market. I think the biggest risk for many of these companies that are looking at the forward picture is we are going to experience a big tightening ahead. The Fed is going to maintain higher rates for longer than many people had expected. given the inflationary problems that exist and the possible inflationary policy. And the fiscal picture is tightening, not easing ahead. And those two things combined into an economy that's already, moderately decelerating is not a great outlook for the economy. And we're starting to see signs of those cracks. I mean, just take a look at Walmart earlier today.
So are you more nervous about higher inflation or slower growth?
I don't think inflation is going to be the big story here. There's not a lot of uncertainty around inflation. Measured inflation is going to be modestly above the Fed's target, for an extended period of time without a lot of volatility. The real risk is, what about that fiscal tightening? Tariffs in many ways are just a tax increase. And part of that can flow through to rising prices, but it can also lead to cutting of spending. In an environment where we're seeing wage deceleration, it's much more likely that we see higher savings come from households and less spending in response to higher prices and lower real growth.
So you think consumers will push back on, even if it's a one-hit pass through on tariffs, consumers will push back on the increase of prices?
Well, I think consumers are just going to look at the prices that they see in the store. And the reality is, if those prices are rising, they can buy less unless their incomes rise. And we have a very different story today than we had a few years ago, when you had tight labor markets, very strong wage growth. People could basically translate that wage growth into spending. The labor markets have softened a fair amount. And that means that consumers are going to be a lot less resilient in terms of their demand when they see higher prices on the shelf.
Should we focus more on the demand impact of tariffs than, say, inflation?
Well, I think that's the big question, right? What the inflationary pass-through is real, but the question is, do people substitute or do people increase their spending, right? You get the inflation if they increase their overall spending. And in order to increase your overall spending, you have to have the wages or the savings to do that. And unless you get asset prices that continue to rise or you get higher wages, they're not going to do that. So it's a negative growth shock. And that is really the big risk in this economy.
Takes us back to the labor market. How strong do you think it is?
Well, it's weakened a fair amount. The most leading measures of the labor market are, hiring is pretty soft. And part of the story here is the federal government cuts to labor ahead, probably 250,000 to 350,000 jobs. That's a few months of payrolls ahead. And all those folks are going to flow into the labor market as incremental new folks looking for a job. That's a pretty big deal when it comes to, an economy that's only adding maybe 1.5 million jobs a year as a baseline number.
Bob, just to put together everything that you're saying, at the end of last year, people were worried about an inflationary shock. To start this year, we've seen bond yields fall on the long end, in part because people are worried about maybe a shock to the growth outlook, that we might see some downside. And you pointed to Walmart, which should forecast lower than expected profit. Is that how you're arranging? Is that what you're investing in? Long bonds, long gold, anything that might be some kind of haven in terms of in the face of an economic downturn?
Well, if you just look at how the markets are pricing things in right now, stocks basically are pricing that the tariffs are a bluff and growth is going to be great. And maybe that'll be the case, but certainly the odds look skewed in the other direction. Whereas the reality is, bond markets, we haven't seen much steepening of the curve so far. We haven't seen bond yields come down all that much. And that really looks mispriced, particularly looking at, being long bonds relative to stocks right now.
Bob, appreciate your time this morning. Thank you, sir. Bob Elliott there of Unlimited. Walmart having a tough ride of it so far this morning. Walmart in the pre-market, Bramo, down by a little more than 8%.
Yeah, talking about how they have a cautious outlook going forward. This doesn't even include necessarily any kind of tariff impact. They say that the consumer is steady, not necessarily accelerating, and they're going to lean into their own brands rather than, say, selling other companies' products. A real question here about how much of a tell this is for the broader economy versus a specific story.
It's bearish when Walmart does well, and it's bearish when Walmart does poorly.
This is the reason why. We'll look in the numbers and we'll get more details before we give some sort of definitive narrative here.
In the next hour on Bloomberg Surveillance, we'll catch up with Meera Pandit at JP Morgan Asset Management. We'll get some thoughts on Walmart when we speak to Sucharita Kodali of Forrester Research, Claudia Sahm of New Century Advisors, Sam Lynton-Brown of BNP Paribas. Lots of thoughts on our conversation with the Treasury Secretary, Scott Bessent. Thank you to all of you for tuning in. We'll break down some of that interview in the next hour of Bloomberg Surveillance and also get some thoughts on the next move from the Federal Reserve, hike or cut, and just how high is that bar for a rate reduction from Chairman Powell from New York City. This is Bloomberg.
or in a better, improving nominal growth environment.
You're seeing broadening at work under the surface.
The U.S. equities valuations we're pretty much at a big.
You're having a global rally and you're having a much more balanced rally.
It's earnings that's really going to drive the market this year. We think the market's ending around 6,600.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Back-to-back all-time highs on the S&P 500 for the first time since the year started. Going into the opening bell, 90 minutes away. Equity futures negative by 0.25% on the S&P. Likewise on the Nasdaq, down by about 0.2%. No real drama on the Russell. The small caps negative by 0.15%. If you turn to the bond market, bond yield's just a little bit lower. We're down 3 basis points on a 10-year, 450. The Treasury Secretary pushing back against the idea they're terming out the debt anytime soon.
This comes after there was severe criticism of the former Treasury Secretary Janet Yellen in terms of lopsiding some of the issuance to shorter-term debt, saying that it's better to lock in yields. Well, if they are going to lock in longer yields, it is not going to come anytime soon, which is a huge sigh of relief that you're feeling in the markets that are saying, okay, we're not going to be overwhelmed by supply.
What does a long way off actually mean, though? Because people were coming in thinking Scott Bessent has talked about this when he was a hedge fund manager, saying that this is what he was criticizing Yellen to do, and yet he's not recalibrating the issuance at the moment. He's saying it's a long way off. At the end of the year, or is this at the end of Trump 2.0?
Sequencing matters here. What I got from the comments that we got from the Treasury Secretary about 60 minutes ago is that they've got some work to do. And they believe that once they've done that work, it will lead to lower long-end yields. Then once you get lower long-end yields, you can think about terming out the debt. I think what I hear from him, just a simple takeaway, is that now's not the right time because they've got a lot of work to do on tax cuts, on spending cuts. There's a lot still to come in 25.
You know, I loved how he framed it at the start, where he was talking about how he spent his whole life with his ear pressed up against the door trying to hear what the guys in there were saying. And now he's in there with his ear pressed up on the other side trying to understand what exactly the market participants are going to take away. And it's this dance of trying to not let the market get away from you, to stymie the plans that you have longer term. It is a very difficult puzzle to put together, though, with a lot of policies on the table.
And when it comes to priorities, we know before going into the administration, he was talking about a gradual approach to tariffs. Lisa, you brought up that hedge fund letter he wrote last year when he said the tariff gun will be loaded but rarely used. It was used once so far only in Trump 2.0, and that was with China. And he wants to see a recalibration, really, of the Chinese economy, more domestic consumption. And he's speaking to his counterpart tomorrow. In the same time, yesterday, Trump said potentially there's going to be negotiations when it comes to a massive deal with China.
Imagine what would happen if he started saying, yes, we're going to term out the debt. We'll do that. That's going to be a priority. And yes, we'll get rid of the debt ceiling. That's going to be a priority too. And then at the same time, we're going to cut interest rates. We're going to cut taxes, rather. And we'll put all these tariffs on March 4th, 25% Canada, Mexico, 25% steel and aluminum in the middle of March. Then in early April, 25% on autos, chips, pharma. Where would the bond market be? If you believe you are the nation's top bond salesperson, and he does, self-described, believe that, that's the last thing you start telling the bond market.
All of a sudden, you've got a bond market at 6% recession on your hands and no 3% growth. So, this sort of goes to the dance that we've been talking about with the Federal Reserve. And in that letter last January that he wrote to investors, he said the upside growth presents the big risk that long-term bond yields could spike. So how do you control that to try to get this non-inflationary growth that really is the 3-3-3 goal?
Equity futures right now on the S&P negative by 0.25%. Coming up this hour, we'll catch up with Meera Pandit of JP Morgan with stocks at all-time highs. Sucharita Kodali of Forrester on Walmart earnings. Their stock is down hard in the pre-market. And Claudia Sahm of New Century Advisors reacting to jobless claims due out in about 26 minutes' time. We begin this hour with some soothing words for the bond market from Treasury Secretary Scott Bessent.
That's a long way off. And we're going to see what the market wants. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
Meera Pandit of JP Morgan joins us now for more. Meera, welcome to the program. Does that give you some increased confidence in the bond market and treasuries?
Not necessarily, because what we have to think about is why yields have risen over the course of the time that the Fed was cutting rates. It's not only a function of more stubborn inflationary data, stronger growth data, and there's still some risks to the upside on both of those factors, but it's also about the debt and deficit. And those conversations have been a little bit quieter more recently, but we are heading into the season of what do we do with the debt ceiling? What do we do with the next stopgap measure from a budgetary perspective? How do we think about taxes on the table? As much as there is room for DOGE, and we should absolutely be thinking about longer term reforming entitlements and cutting spending in the right ways, it is going to be mired by the tax bill that we have on the table, even just extending what we already have. So I do think that there is some room for yields to continue to increase from here. We're going to see some two-sided volatility throughout the year, but I think the next stop could be a little bit higher for yields after having a bit of a breather over the last few weeks.
As the focus shifts back towards tax cuts, which potentially pushes bond yields higher, what would that mean for equities?
Well, unfortunately, if we're going to see an extension of the status quo, if we're going to see a $5 trillion bill on something that is simply the Tax Cuts and Jobs Act, as opposed to more corporate tax cuts, additional tax cuts for consumers, then it's really just maintaining where we are today. It's not necessarily going to drive new consumption, drive new equity market highs. Maybe there will be a bit of enthusiasm about it. But the difference between now and what we saw in 2018 is that 2018 you had 21% profit growth, about half of that coming from margin expansion, and that really supported the markets throughout the year. Even though it was a down year, we still had 19 new all-time highs that year. So the trouble is this year, if we have tax reform second and also tax reform that really isn't a splash, not including the deficit, but of course from a market perspective, then how much is that going to really juice up the markets from here? And in fact, in the reverse, how much does it affect how corporations act when they're really thinking about tariffs on the table here? What you're seeing potentially is a pullback from capital outlay plans. If you look at the NFIB survey, not only a spike in uncertainty to the third highest recording we've seen, but also if you look at that portion that looks at capital outlay intentions, that had a big drop as well. So it is important to think about the downstream impacts, not just what the market is reacting to today.
And I believe that Walmart is having their call, and just in line with that, their guidance was below expectations, and it didn't even include what could potentially come with the hit from tariffs, but they're already planning for it. And I know you can't speak specifically to this company, but the idea that you have this type of commentary at the same time that we just got the third all-time high on the S&P 500 for 2025, does that make you think that people are being a little bit optimistic in some of the pricing right now?
We should feel good about the earnings that we have through the door, because not only have we seen earnings expectations from the fourth quarter move from just north of 11% year over year for the quarter to north of 16%, but you also have half of that contribution coming from financials. So it's not a Mag 7 story. So we should feel really good about the earnings season we had. The question is, if you do see an implementation of tariffs, where does that hit profits? You know, if you think about the margin side, 70% of the contribution this earnings season has come from margins. And the question there is, if the consumer is not really willing to eat the cost of higher tariffs if we do see them after 15% egg prices, if they are fed up, then that's going to hit that margin story, and margins are what have been driving profits. So there is a little bit of a concern there. And then from the other perspective, it's also revenues. About 40% plus of the S&P 500 gets its revenues from abroad, particularly areas like tech, 56% revenues from abroad. So then you also have to worry about a revenue slowdown in an area that is already a little bit weak.
So what's the haven trade at a time where you've got a lot of crosswinds that could potentially lead to opposite outcomes, opposite tail risks?
What we have seen, and I think this is an encouraging side from the market, is everything is mean reversion right now. You see areas like Europe outperforming, China outperforming relative to last year, Japan, India. You see the rest of the S&P 500 relative to the Mag 7. I think some of these rotations are sustainable, some of them less so, but I do think particularly within the U.S., the rotation to everything else is underpinned by earnings. When you think about something like financials driving 50% of earnings growth this past quarter. So there are some areas within that are sustainable, some less so. But I do think that the rotation you're already seeing underway for people getting a little bit more diversified across the board has been a healthy sign.
Is that all driven by policy? The idea that people are falling in love with Europe because Trump's pushing them to spend more? The idea that people like small caps back in the United States is because the walls are going up?
I think part of it is a little bit more mean reversion from a valuation perspective. European valuations down in the dumps. I was on this show about a month ago and made the case for why European equities could do really well if we think about financial conditions starting to loosen, a more interest rate sensitive economy starting to actually benefit from rate cuts, a massive pile of consumer savings ready to be deployed. Maybe we do see trade deals down the pike from a European perspective. The trouble with some of this is you're seeing about 80% of the rally within Europe, and indeed many markets except for Japan, really coming from multiple expansion. So the question is, are people getting excited about something that's actually going to pan out or not? I think that's the big question for me right now around Europe, because we haven't really seen massive movement on a lot of those items I just mentioned, and yet there is certainly the enthusiasm there that it might bear out.
The banks in Europe up 18% in 2025, which is unreal. I keep referring to the date because it's only February 20th and the banks are up 18%. I don't know what I do with that now. Do you take the rest of the year off? What do you do if you've been sitting on that? I listened to you. I got into European equities. I wish I had. I'm just saying. And European stocks have had a move like that. What do I do now?
I think we're at a pause and see, because I think tariffs will be a big distinguishing factor. But let's also think about the other international markets and where we think that there's some legs and not. I think there could be a little bit more legs in China, because a lot of that is really centered around a micro AI story. I think that the reversion in the other way from a Japanese perspective is perhaps unwarranted, because actually, if you look underneath the surface, multiples are driving most equity markets right now, whereas underneath the surface, there's a big currency component, of course, to Japanese returns, but it has the biggest contribution from an earnings perspective. So I don't think that that's an area we should leave on the cutting room floor. Then you think about an area like India, had great run last year and in the last couple of years. The earnings growth story are starting to deteriorate a little bit, and ultimately the multiples there are pretty high. So I think you have to go market by market and think through where are their legs, where are there areas where we should think about paring back a little bit. But right now it is about being broadly diversified, because that rotation has played out and it has worked for clients.
Meera, appreciate it. It's good to see you, as always. Meera Pandit there of JP Morgan Asset Management. Mentioned Japan near the end there. Dollar yen, big move today. The biggest mover in G10 in foreign exchange against the US dollar. Dollar yen with a move of 1 full percentage point. Lisa, just now, breaker 150, 149.93.
Increasingly, it seems like the Bank of Japan is on a hiking path. They always seem to move in the opposite direction of central banks elsewhere around the world, and this is giving some momentum to that. But it goes to this question of how much ongoing yen strength can rearrange some of the flows that we've seen in the past that really have underpinned some of the U.S. asset outperformance.
That's the big mover in foreign exchange. The big mover in the pre-market right now is Walmart. That stock is down by more than 7%, approaching 8% lower in early trading. More on that in just a moment. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Commerce Secretary Howard Lutnick said President Trump wants to abolish the IRS. Lutnick told Fox News the president wants instead to raise revenue by charging other countries. Trump himself has also floated the idea of abolishing federal income taxes as a part of his tariff and foreign nation tax plans. The Port of Los Angeles saw a record January ahead of President Donald Trump's planned tariffs. The busiest trade hub in the U.S. moved 8% more containers last month than in the same period a year ago. According to the port, the boost was largely driven by retailers. The San Francisco 49ers are considering selling a 10% stake at a valuation of more than $9 billion. That could make the NFL team one of the world's most expensive sport franchises. Sources say it's still unclear if the team will look for a private equity firm to buy the stake or a wealthy investor or family. And that's your Bloomberg Brief, John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, the Morning Calls Plus. Sucharita Kodali of Forrester Research on Walmart's disappointing numbers earlier this morning. That conversation up next, live from New York City this morning. Good morning. Equities right now, just a little bit softer. We're down by close to a third of 1% going into the opening bout. The opening bout 1 hour and 14 minutes away. Let's get you some morning calls. First up, Wells Fargo raising its price target on HP, expecting continued benefits from the AI PC cycle. The stock is up by a third of 1%. Your second call from KeyBank raising its price target for Nvidia, saying the chip giant's earnings report should alleviate DeepSeek concerns. That stock is up by a little more than a tenth of 1%. And your third and final call from the team over at Jefferies, upgrading Roku to hold. The analyst saying it strengthened its position as an ad platform. That stock is up by a little more than 2%. Walmart shares falling in the pre-market after the company's full-year profit forecast fell short of analyst estimates. That stock is down by more than 8% going into the cash open. Sucharita Kodali, Forrester Research, joins us now for more. Sucharita, welcome to the program. What went wrong for Walmart?
Well, I think that a lot of the softness right now is due to underperforming from an earnings expectation standpoint, but it also sounds like some of that may be one-time charges, like perhaps some of the payouts for some of the opioid lawsuits. The top line numbers were actually fairly strong. It suggests that Walmart continues to gain share from other retailers. There are companies like Target, which are competitive with Walmart, which have been particularly soft. Walmart continues to outpace them. Walmart's numbers from a revenue standpoint are mid-single digits, and its comp store sales were stronger than certainly the growth in the retail industry now. So it's doing okay from a revenue standpoint. I think some of the earnings outlook just suggests that the consumer is likely to be softer in 2025. We still see consumer confidence down, and then you also have looming tariffs that they mentioned on the earnings call as well.
It seems like it was that forecast, not the numbers that they posted, talking about overall net sales growth for the full year in the range of 3 to 4% versus the expectation for 5%. How much of what we're seeing in terms of the reaction of the stocks is simply because the shares are up 77% over the past 12 months, given the fact that they have outperformed, and now the bar is just really high?
Yeah, we see this often. You typically often will see this with tech companies, right, where there are huge run-ups and then an earnings call happens and then it's not as high as people expected it to be, and then you see a pullback. And that sounds like that's what's happening right now. The macro story about Walmart, the bull story, is that this is a retailer that has executed incredibly well. They continue to execute really, really well. And they're taking share from much of the rest of the retail industry. And as far as commodities are concerned, they are absolutely holding their own with against companies like Amazon. The bear story is more of a macro story, and Walmart is a bellwether for the rest of the economy because, and certainly for the rest of the retail industry, because if it is soft for Walmart, it's going to be soft for a lot of other retailers as well. This is a company that does incredibly well in any kind of an economy, whether consumers are doing well or whether there's a recession. But for Walmart to suggest that the outlook's going to be softer, it probably suggests that that consumers are entirely going to pull back on spending across a number of categories this year.
That's exactly where I wanted to go, Sucharita. If Walmart catches a cold, does Home Depot, does Target get the flu? I mean, is basically this signaling that there's some real negativity coming from Home Depot and Target and some of the other retailers that are set to report earnings in the next few weeks?
Target has had a bad run for the last few quarters, so it is going to be surprising if they're able to pull a rabbit out of the hat when Walmart has not necessarily suggested a positive outlook, or I should say not as positive of an outlook as it's had in the past and as spectators hope. As far as Home Depot and Lowe's in the home sector, that's a little bit different. We saw some pretty soft numbers with Toll Brothers this week, and those kinds of sectors are more interrelated. And we have an interest rate issue, which is really impeding the home sector right now. Not that interest rates are at record highs. They're higher than they've been in a long time. But kind of as far as consumers have seen interest rates like in the 90s, we still have kind of good levels. So until consumers get more accustomed and are prepared for the fact that it's a new normal, I think that we are going to see softness likely in the home sector, but that's a little bit different than what we're seeing with mass goods that get purchased at Walmart.
Sucharita, when it comes to tariffs, every day there seems to be a new item. Yet last night it was lumber that's added on Donald Trump, the President of the United States, list of what he might want to go after. At what point will we see Walmart and other retailers start to incorporate what tariffs could mean for when they give out guidance?
Well, we already see that companies like Amazon have. It's a pretty highly ranked risk factor in their SEC filings. Walmart is in a watch and see mode because it is difficult to know whether these tariffs really have teeth or whether they are political theater intended to basically have negotiating leverage and some of these other issues like immigration. So TBD, we do know that the Canadians export a lot of lumber to us. That absolutely is going to affect the home sector, arguably even more than Walmart, although there are probably some elements with new store development and some issues in the warehouse that could be affected by that. But there are other things too, like, there are a lot of consumer goods like maple syrup that we get from Canada, which could potentially be much higher from a pricing standpoint in the future. And as far as Mexico is concerned, the tariffs there are likely going to be on produce, potentially automobiles. So we see a variety of different sectors. Walmart likely imports a lot of the produce that we see in stores from Mexico, and that is potentially vulnerable to some of these new tariffs.
Does companies like Walmart and others have to put pause then on potentially expanding, even in places like Mexico and Canada? I know they have a huge supply chain when it comes to these three countries because technically we are in a trade agreement with them, the USMCA.
Well, there's not only what they're importing, but Walmart has presences in those regions too. And that is also something that impacts their international numbers. And we just don't know what ultimately the impact is. It really depends on how much, and Walmart is going to know this much more than anyone on the outside, is how much is actually imported, how much is exported for that particular store. And then you have to calculate all of the additional expenses that may be incurred due to some of these federal changes.
Is there any bull case right now, Sucharita, for the retailers, given the tariff overhang, given a consumer that's steady but not accelerating, and given the fact that the likes of Walmart already have pretty high valuations?
Yeah, I think that 2025, the best way to call it, this is a white knuckle year. I think that people are just hanging on and holding on tight because there's going to definitely be a lot of volatility. We just don't know what 2025 holds. I can't say that it's going to be categorically strong or weak. There are so many unknowns. We don't know what's going to happen with tariffs. We don't know what's going to happen with the bans on companies like TikTok. We don't know what's going to happen if the de minimis thresholds go away. So there are a lot of things that are uncertain. We don't know anything about. We don't know what the future of interest rates holds. So there are a lot of uncertainties, and there are a lot of sensitivity analyses that analysts are running as we think of best case scenario, worst case scenario. It is kind of all we can do is operate as best we can with the information we have at any given moment in time. E-commerce continues to grow, but even e-commerce is slowing. And, kind of one of the things about Walmart is that their e-commerce is outpacing the industry. And they said this past quarter was growing at 20%. We have e-commerce as an industry in the United States growing in the low teens, high single digits. So they're significantly outpacing that sector. But Walmart's so large that unless the stores are also outpacing, which at the moment they are, there are definitely headwinds ahead.
The stock is down by 8%. Sucharita, appreciate it. Sucharita Kodali there at Forrester Research. This guidance does not include tariffs. That's the big story here.
Yeah, how can they even begin to include tariffs? And right now, investors don't have a lot of patience with anything that isn't stellar and explaining how you're going to get around some of these obstacles.
It's a very uncertain year ahead. Up next on the program, jobless claims. Equity futures on the S&P negative here by a third of 1%. We're down by about a quarter on the Nasdaq 100. The Nasdaq on a 5-day winning run. Coming into Thursday on a Russell, the small caps down by a quarter of 1%. If you switch at the board, jobless claims about 10 seconds away. At the front end of the curve, the 2-year yield is lower by 2 basis points. The 10-year down by 3. It's a break of 450, 449.95. With that jobless claims data, let's cross over to Bloomberg's Mike McKee. Good morning, Mike.
Good morning, John. We're waiting for it to drop. 219,000 is the number after 214,000 revised up by 1,000 last week. So no real change and no real issue for the economy in terms of the labor market at this point, which is what we've been hearing all week from members of the Federal Reserve. On a continuing claims basis, 1,869,000. That's down from, or that's up from 1,845,000 the prior week. Now, the Philadelphia Fed is also out, and the Philly Fed comes in at 18.1. That's down a lot from 44.3. The forecast was for being down a lot more. Prices paid is the one that everybody is following with that one. It is up to 40.5 from 31.9. One other thing on the jobless claims that I know everybody's been interested in is what are we seeing in terms of the layoffs of federal workers. Initial claims for unemployment benefits filed by former civilian employees totaled 613 in the week of February 8th. That's the newest numbers that they have. That's an increase of only 14 from the previous week. 399 filed by newly discharged veterans. So the numbers, if we are seeing a significant number of people laid off, have not started to move yet, but the layoffs didn't really start until the last week or so, so we'll keep an eye on that.
Mike McKee, thank you, sir. It's a small upside surprise on jobless claims. No drama here. It comes in at 219. The estimate was 215. This was something that BNP Paribas said in the last week or so. Comfortably numb. The Federal Reserve is comfortably numb. They're not going to move in one way or the other based on this information.
Which is a reason why people are looking to the growth potential and how that could be a feature that really will play in. What you're seeing right now in terms of response is not much, but you have seen that downward trend of 10-year yields and 2-year yields throughout the morning. And it's not because of this question around the Fed. It's around question of growth. It's around questions of supply and what's going to happen in the long end. And it's around questions like how companies like Walmart will handle some of these tariffs at a time where the consumer isn't necessarily accelerating.
You can't provide guidance, and I think that's the key theme here. It's very difficult to provide guidance. When we caught up with the Treasury Secretary about an hour ago and talked about things like issuance, he can't provide guidance on what the issuance is going to look like, the profile of that issuance a year out, 2 years out, because we don't know how much we're going to need to issue. We also don't know what the economic backdrop will look like either, and how low or high yields might be at the long end.
And we've been talking about at what point this has ramifications, this uncertainty for the economy in the here and the now. Right now, you're not seeing layoffs accelerate. We'll parse through this and we'll be watching this high-frequency indicator. But amid this paralysis, you're seeing a lack of conviction among corporate executives that need to take plans that will ultimately decide who gets hired and who gets fired. And I think that's what people are trying to assess at this moment.
Claudia Sahm of New Century Advisors joins us now for more. Claudia, welcome to the programme. I want to get straight to that economic data. Jobless claims, it doesn't look like there's a ton of weakness here. When you look at the labour market, from above, from 35,000 feet, any reason for concern at the moment?
So 35,000 feet, the labor market still looks really good. Now, clearly, we have to pay attention to the layoffs that are happening within the federal government and how that might spread through contractors and other kinds of grants that are held back. But that is in terms of at the high level, that's just one corner of the labor market. But I think back to the point you had about this uncertainty, we came into this moment with hiring rates that look kind of unusual for the amount of layoffs. Like, layoffs look really good, but we are in an environment that isn't absorbing the workers who are out there looking for jobs. So if we do get into a place of layoffs, then that can be a real problem. It can turn into a problem very quickly. Not a problem now, but it could be.
Claudia, has there ever been an analog, a time in history that you can point to where there was a lot of policy uncertainty and a pretty balanced labor market, someone that was kind of in stasis, not expanding, not contracting?
That's tough. I mean, it is true that when we start into an administration, there is going to be a lot of a new administration uncertainty about where the economic policy is going altogether, right? So we have these moments in time, and it doesn't have to, really cause a big upset in the labor market. It's more what the policies turn into going forward. So we're in kind of this holding pattern at the moment, but I wouldn't necessarily say this is out of the normal.
Claudia, I'm wondering, as an economist, how much you're increasingly looking at the economic data put out by the government versus the economic data put out by corporate executives. And I say this because increasingly what you're seeing in the stock markets, corporate earnings are really the driver of pretty much everything across the board. I wonder if that's increasingly on the bond side and from an economics perspective as well.
Well, I think it's important we need to be looking at all pieces of data. A lot of the government data do a much better job of rolling it all up, giving us the big picture, the trends, where we're going as an economy overall. Clearly, there are going to be important idiosyncratic at the firm levels, the earnings levels that will drive, say, markets in an important way. So I don't think we should ever be in an either or situation. And there can be times where it's really difficult to match up the two, where you have things going on in sectors that are very different than the economy as a whole.
Can we talk about what's going on in the job sector at the federal level? If we're seeing a Dogification of the federal workforce, what kind of average numbers do you expect to be added every month? Last year was about 35,000 on average of federal workforce employees added to the jobs report.
Right. So at this point, it's really hard to get a firm sense of numbers coming out of Doge and just the reporting. We're getting things very much in piecemeal in terms of the layoffs that have actually happened, the layoffs that are likely to happen. So I think, keeping it in perspective, federal government workforce, less than 2% of the full government. If we had the full probationary workers, so those 200,000 workers that have been targeted, if they were all laid off, that's a 1/10 of a percentage point on the unemployment rate. These are small numbers in that big picture. They're incredibly disruptive in the federal government. They could be disruptive for services, but we have to we're getting constant headlines of layoffs, and they will add up. It's just a question of how big those really are in reality, and that's just not known yet, and how it spreads. Right. This is not just about the federal workforce that's being targeted. So I think at this point, it's clearly a negative. I can tell you the direction that looks like on the jobs report. But whether it's the kind of numbers that are portending of a recession or a major contraction of the labor market, that would require a lot of amplification outside of the federal government sector.
On the flip side, how are you taking into consideration what we're seeing on the immigration side with the Trump administration, deportations and much stricter border control?
Right. So again, this is one where the numbers are going to really matter. I mean, in terms of, are they really doing are the deportations really adding up in a way that the administration aspires to? And they may not be there now, maybe they'll get there, but that a lot of that is going to be potentially destructive to the supply side, right? We're losing workers that have been a big boost to growth coming into this, could be a drag on growth. But again, at this point, the numbers being aspired to far exceed what it looks like are actually the deportations that are happening. So, I mean, at the end of the day, in the data and what's happened, the reality matters. And we don't know what the reality is right now.
Claudia, appreciate your insight, as always. Claudia Sahm there of New Century Advisors on the labour market. We can talk about the reality of the data we got just moments ago. 219, a small upside surprise on jobless claims. The estimate was 215. Mike McKee, I want to bring you back into the conversation. We had the minutes from the Federal Reserve's last meeting yesterday afternoon. They did reflect on some of the policy uncertainty. What jumped off the page for you?
Well, I think that was the big issue for them at the time in terms of monetary policy, because the Fed doesn't know what the president is going to do. And that folds into this whole unemployment claim issue with Doge firings of people. We don't know exactly how many are being fired or whether they're going to stay fired. And when you look at the states that have the most federal employees, Virginia, Maryland, California, Texas, all of them saw declines in jobless claims in the last week. So it's hard to predict what's going to happen with the economy. Beyond that, I think the biggest thing is the Fed talking about the possibility of suspending its balance sheet reduction if they don't fix the debt ceiling issue. That's something that had not been brought up before, and I think they stuck that in there because they want the markets to know it's a possibility, probably not going to happen, but it's something to think about.
Something Lisa brought up as well. Mike, appreciate your time this morning, sir. Mike McKee, something Secretary Bessent reflected on too, that he doesn't want to compete with the Federal Reserve.
Well, I mean, if they're buying a lot of the debt, that becomes a problem for them at a certain point. If they're selling the debt, that's a good thing for them. If they're selling the debt, which is essentially what the runoff is, that becomes a real problem for that when the U.S. government is also trying to sell it. So it's, this is such an interesting moment because on one hand, he doesn't want to comment about the Treasury issuance, or he doesn't want to comment about the Federal Reserve and the Fed policy. At the other hand, they work very much at lockstep.
He did subtly agree with the idea that perhaps them reducing interest rates by 50 basis points and then 25 and then 25 at the end of last year may have contributed to the high yields at the long end of the curve.
So right now he's taking on the role of Treasury Secretary. Last year when he came on the show with us, he was not in that position, and he had a much more aggressive commentary on exactly the timing of some of these rate cuts and that maybe it was inopportune.
If rates go down, rates should go down. And of course, rates went down and yields went up.
Well, Jay Powell said that it wasn't because of inflation expectations. So, could go around
Nothing
in
to see
circles.
here.
Exactly.
Sam Lynton-Brown of BNP Paribas joins us here in New York. Welcome to you, Sam, over from London. It's good to see you, buddy.
Yeah, good morning. Thank you for having me.
Let's start with the Federal Reserve. How numb is the FOMC?
The economy's strong. Labour demand is actually increasing. And our view is that once tariffs kick in, they'll be more inflationary than the market expects. And as a result, this is a Federal Reserve that won't cut rates at all this year.
So no cuts this year. Why do you think those tariffs will be more inflationary than people expect? What tells you that?
When we look at previous episodes of the impact that tariffs have on inflation, because the starting point of the US economy is currently very strong, the labour market's very tight, the Fed are going to have to be very attuned to inflation expectations. So there's an argument in the market that tariffs are just a short-term price level increase, and therefore the Fed should look through them, especially if they are not positive for growth in the medium term.
That's an argument from the Fed. Governor Waller's made that argument.
It is, but if we think about, for example, the dots from the Fed back in December, where they shifted significantly in a more hawkish direction, they implied higher inflation, they implied far fewer rate cuts than they previously suggested. We'd argue that's a Fed that really agrees that if tariffs do come through, and some of the participants were including them in their forecasts at that meeting, that it will be consistent with the Fed not cutting rates this year.
Increasingly, people are actually looking at the potential for growth to disappoint, and you're seeing that with Walmart earnings today and just in general. On the margins with some of the commentary from companies, what would it take for you to change your view to think that maybe some of these policies are not really going to be surprisingly inflationary, but quite the opposite?
Growth expectations are very high in the US at the moment. So the bar for earnings to be a little bit weaker than expected and then trigger some sort of position reduction in a very sort of well-held bullish equity view in the US isn't that high. So I think it's possible, but the key is when the labour market's this strong, the Fed, to your earlier question, John, around how numb are they can be quite numb to it.
Why do you keep saying that the jobs market is so strong? Because what we're seeing is there isn't that much firing. The layoffs data doesn't seem to be showing any alarm bells, but we're not seeing incredible acceleration in hiring in any way.
We, until the latest non-farm payrolls data in the market, all thought that the line of the moving average of hiring went like this. That line got revised so that it now looks like this. So labour demand in the US troughed 6 months ago, and it's been improving since then. If Fed policy is that restrictive, that's a dynamic that actually shouldn't be happening. Labour demand should be continually softening. So we have an unemployment rate that's falling, hiring that potentially troughed 6 to 9 months ago, and job layoffs that are still very low. So it's an environment where the Fed can keep policy on hold, we think.
Sam, you're visiting us from London, so I'd love to get your take on what's going on in Europe. It feels like Trump policies have really pushed Europe to spend more, especially on defense. But you are a little bit more cautious on actually what happens in Germany. Do you see higher spending coming out of Germany following these elections this weekend?
Higher defense spending in Europe is a question of when rather than if. So that's the medium-term path. It seems very clear for a number of reasons, and Germany will be a part of that, especially if this weekend, as we expect, we get a CDU-led coalition. I think in the market, though, we already price a lot. The market seems to be in this mindset that because there's elections, because you're likely to have a coalition that wants to spend more, it's going to happen quickly. And that's not how it works in Germany. The average time for a coalition to form is more than 2 months. So the absolute best case scenario from this weekend is that for the market in terms of more spending is that you see the parties which don't want more defence spending to do quite poorly, the parties that do want more defence spending to do well. That's then going to enter into a 2 to 3 month, probably at a minimum, process of coalition talks, which may result in a suggestion to increase defence spending in the second half of this year. We think they'll increase by 15 billion euros. In Germany, that's about 0.35% of GDP. It's a lot for Germany. But when we compare it to the type of fiscal deltas that we talk about in the US, these numbers aren't huge.
So do you think the market is at peak pricing in all of this spending in Europe?
I think it's over its skis on the likely time frame, both with respect to expectations of an increase in defence spending in order for there to be a ceasefire in Russia-Ukraine, and also the speed at which it thinks Germany is going to increase defence spending. So we like long duration in Europe. We like long burns.
So just quickly, where's that leave the euro?
We're bearish. We think the market's over its skis on the degree to which Europe increases its fiscal stimulus. And at the same time, on the tariff side, while it's very hard to predict exactly what's going to happen, we can look at market pricing. And market pricing today is extremely complacent. We think there's almost no tariff risk premium embedded in euro-dollar at the moment. So we're looking for parity this year.
Parity, which is not too far away.
It's not. But if we're there at the end of the year versus a forward that's at about 106, you're still looking at a 6% return. It's not too small of a move for euro-dollar.
Sam, it's good to see you. A clinic as always. Sam Lynton-Brown there of BNP Paribas. Euro-dollar right now, 104.47. We're positive by about 0.2%. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. President Donald Trump said a new trade deal with China is possible, speaking to reporters on Air Force One Wednesday. Trump did not describe the parameters of a potential deal, and any agreement would face significant obstacles. Trump has ratcheted up pressure on China with additional 10% tariffs on all imports from the country. The IRS reportedly planning to fire 6,000 workers today. Multiple media outlets reporting that the government workers who will lose their job were more recently hired and therefore have probationary status, making them easier to cut loose. The firings come less than 2 months before the April 15th deadline for Americans to file their taxes with the IRS. The flu is overtaking COVID as the deadlier virus in the U.S. this winter. It's the first time in 5 years the seasonal illness has surpassed the pandemic virus. The CDC estimates that the influenza has made at least 29 million people sick and resulted in 16,000 deaths since last October. Meanwhile, mortality from COVID has been declining. And that's your brief, John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead and bring you some of our interview with the Treasury Secretary, Scott Bessent, in just a moment. From New York City, this is Bloomberg. Equity futures here down by about 1/3%, just a bit softer going into the opening bout. That opening bout is about 40 minutes away with some morning moves this morning. Here's Yahara Hacker. So, Yahara.
Hi, John. We start with Walmart. Those shares are currently down 6.5%. The retailer forecasting lower than expected profit for the full year, calling into question the health of the consumer. And adding to the uncertainty is a point that you guys made before, which is that this guidance doesn't even include the potential impact of tariffs. But maybe, possibly, we'll get more details on the earnings call, which is underway right now. Next up, it's Alibaba, and it's a different story there. Shares are up nearly 10% because its e-commerce business, both at home in China and internationally, smashed expectations, as did its cloud and AI divisions. And the results are a positive signal as Alibaba tries to stage a comeback after that regulatory crackdown by President Xi. But Jack Ma looks to be on President Xi's good side now with, of course, that meeting earlier this week. And last up, we have Carvana. Those shares are down some 5% here. And yes, it posted a quarterly revenue and profit beat. But what put off investors is the amount that Carvana makes per vehicle sold came in lower than expected, which could be trouble for margins moving forward. But for Adam Jonas at Morgan Stanley, this is nothing but an opportunity. John?
Yahara, appreciate it. That name is down about 5%. Three names to watch going into the opening bell there. Equity futures just a little bit softer. As we go into that open, some things to look out for. Lots of Fed speak later on today from Goolsbee, Barr, Kugler and Musalem. Tomorrow, some economic data, US PMIs and UMich sentiment. Into the weekend, Germany's snap elections and a sneak peek of next week. Earnings from Home Depot on Tuesday. And then on Wednesday, it's the big one. Earnings from Nvidia. That's the big one for next week. Let's turn to politics and turn back to the economy. We caught up with the Treasury Secretary Scott Bessent earlier on this morning on Bloomberg Surveillance. He had some soothing words for the bond market.
We're going to bring down energy costs. We're going to bring down regulation. And I think once the Tax Cuts and Jobs Act is made permanent, then we can have a revenue increase, cost decrease.
What is the medium term? And then once you see all those things, let's say those ambitions become reality, then do you start to think about terming out the debt?
Sure, but that's a long way off. And we're going to see what the market wants. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
Tyler Kendall joins us now from Miami. Tyler, we heard from the president yesterday for more than an hour. We heard from Scott Bessent, the Treasury Secretary, this morning for more than 25 minutes. What's your take on where the policy emphasis is now going into the next few months?
Right, John. Well, that's a big question, particularly when we look at all the different policy proposals that we heard from President Trump, particularly when it came to tariffs. I was struck by Scott Bessent's comments there as well about what the future of economic and foreign policy mean coming together. Now, here at FII, I'm waiting for remarks from Special Envoy Steve Witkoff. He's still here on the ground in Miami, of course, one of the central players in this continuing conversation about foreign policy for this White House. And notably, I'm going to see if he says anything, builds off of any of those comments that Treasury Secretary Scott Bessent told you all, particularly when it comes to the future of sanctions, that the U.S. is ready to either ramp them up or tone them down, depending on what happens with talks between Russia, Ukraine, and the U.S. We could get some big headlines today, John, particularly as we know that Special Representative Keith Kellogg is in Ukraine today meeting with Zelensky.
Tyler, appreciate it. Look out for that. Some coverage from Tyler Kendall down in Miami. From New York, we're going to wrap it up. Annmarie, foreign policy, a big focus today.
Massive focus. And what he said basically is both options are on the table, which says to me the administration doesn't know exactly where the negotiations are going, but they can use sanctions as a lever to potentially get Putin there, meaning they can put heavier sanctions on Moscow or they can wind them down if they think potentially he's close to a peace agreement. But the rhetoric right now is very hot between Zelensky and Trump. And Scott Bessent, the Treasury Secretary, was just there. And he said that there seemed to be a signal he was going to sign this mineral pact, and then he went to Munich and didn't.
We have a frustration trying to understand what the broader framework is and listening to these different messages that are coming in the rhetoric to understand how we're getting closer or not to that. The market's struggling with that. We saw Europe pricing in the chance for resolution. Now that's being walked back just a bit.
It's a really unique moment. We have a president who's in his second term but had a 4-year break. And he's had a 4-year break and knows exactly what he wants to do. So they're trying to get a ton of things done really quickly. Just think about it. I keep saying this. We're only a month in. And think about how many things have been thrown up against the wall.
I'm really going to be looking forward to what this conversation looks like 100 days in. Where are we on all of these fronts? Growing up against the wall. Last night, lumber was added to the list of these potential tariffs.
Let's see what sticks. Coming up tomorrow, we'll catch up with Steve Chevron of Federated Hermes. We'll speak to Kelsey Barrow of JP Morgan, Jason Furman, the former chair of the Council of Economic Advisors under President Obama, and Nadia Lovell of UBS. From New York City this morning, good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.